before, right? We see a slowdown and then we see a rebound. So what we're looking for is a consistent slowdown. The early numbers are certainly suggesting that. So we're not expecting a reacceleration in economic activity. We've already seen a step down in household spending. It's just a matter of some more evidence, and the Fed is also looking for the same.
Can you frame how important then CPI is going to be on Wednesday in terms of either supporting your thesis of a gradual slowing, but also disinflation versus sort of rejecting it?
Right. I mean, the CPI data, we expect them to show what the PCE data are showing, right? The inflation is sort of moving sideways, really not much of an improvement right now. But what we are seeing is a deceleration, a deflation in goods prices. The services side is where, all the problem lies. That's what's boosting prices. In, the CPI versus PCE, you've got that housing component, which is much weightier in the CPI numbers. We do think that that is also going to come down, but gradually. And we also think that this, ex-housing component of core services, that is also something that we're watching very carefully. And all indications are, if you see services spending, sort of moderate, then you would expect that, if as that demand slows, that those price pressures will also abate. But if you look at, there's conflicting evidence, right? If you look at some of the numbers on travel, on entertainment, those numbers are still, they're still signaling that there is staying power to the services side, but we do think that we're going to see, over coming months, a moderation. The whole idea is that the U.S. economy continues to grow. The Fed has delivered over 525 basis points of tightening without causing a recession. They're going to be careful as they move forward. We think the base case still is that the U.S. economy grows, but it slows down. The momentum decelerates.
Robeida, appreciate it. Robeida Faruqi there, High Frequency Economics, looking ahead to Wednesday, a Fed decision and the data in the morning. Heard a similar thing from Mike Gapen. The economy may be cooling, but it's not cool. We've heard so many different versions of that, haven't we, over the last few weeks?
Michael Gapen said that he muted our coverage before we actually got the result because we were so negative, and he just disagreed. And he was sort of, doing a very non-subtle humble brag.
He's Team December, right?
Yeah, and he's been completely correct. So, as a way of sort of raising that point, it is interesting to see all the ways that people can say we have no clue what's going on and the data is messy. This from Steve Englander basically saying the FOMC is not going to say anything because they can't, because nobody knows anything. The press conference could focus instead on immigration and R-Star rather than immediate policy moves because, you know what? They probably have more to say on those things.
Yeah, you think they will?
I don't know, no.
I think that's what the press is going to be about.
Can you imagine?
Peter Cheer of Academy, the establishment survey makes it look like an incredibly strong and healthy labour market. The household survey makes it look like a very weak labour market. It is both the best of times and the worst of times. And whatever you were thinking going into Friday, you did not change your mind based on that data.
Well, it was a great kind of piece from Peter Scheer because it just sort of underscored this disbelief of numbers that seemed so messy as to be rather unbelievable.
And then you've got a trade on it. Equities a little bit softer this morning. Coming up next, Troy Gajewski of FS Investments, Bloomberg's Josh Wingrove, and Mike Schumacher of Wells Fargo, live from New York. The second hour of Bloomberg Surveillance, up next.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching the China Show.
This is Bloomberg Technology. This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
What we are being reminded over and over again is how difficult this economy has become to understand.
You are seeing some parts of the economy slow, but it's not fallen off of a cliff.
Yes, growth is slowing, but it's slowing to a level that is still well above trend.
The Fed has the luxury of being in a strong position that they can hold off, be patient, and see how things play out.
If they're going to lean in one direction or the other, they're going to lean towards caution before cutting too quickly.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. Your equity market on the S&P 500, negative by 0.1% on the S&P. This week is all about Wednesday. This is the lineup for you. Wednesday morning, CPI, 8:30 Eastern Time, onto a Fed decision at 2 p.m., 2:30 with Chairman Powell in a Fed News conference. And already this morning, a controversial take from Ben Laidler of eToro, who turned around to us about an hour ago, Lisa, and said, non-event on Wednesday.
Well, it's easier to say it's a non-event than it's going to be this massive event, given the fact that we're looking at such great uncertainty, not only in just what the trajectory of the economy is, but how seriously to take the data. So at a certain point, it's fair to say that, even though it probably will move the needle. Look, a lot of people saying, and I think that Lori Calvasina is right to say that if there are no rate cuts, that's going to raise a specter of potentially a stock sell-off, particularly in the stocks that are more sensitive to how high rates currently are.
Well, let's get to stocks and look at equity futures together. Let's start with the price action. The scores look like this on the S&P 500, a little bit softer on the S&P. If I could predict what Wednesday's CPI number would bring, could you guess what the market would do? And this is an important exercise because we had a pretty hot wage growth figure on Friday, a really, really decent headline figure on payrolls, much better than expected. Yields did what you'd expect bond yields to do, and then equities fell by 0.1% on the S&P.
So, yeah, no, I have no idea. If you give me all of the information right now for the entire week, I'll have no idea how the bond market or the stock market trades in any capacity, because we've been saying not only for stocks is it macro policy, which is completely uncertain, but you also have the Worldwide Developers Conference for Apple. What if Siri disappoints? Well, all of a sudden, there's a $470 billion rally that's really a question, how quickly they can move to AI. What if NVIDIA's stock split fails? What if it actually doesn't make a needle, doesn't move the needle considering how much those stocks have rallied? Do people say, wait a second, maybe we don't believe in the rock star of AI? Maybe his leather jacket is passé. There are all these questions that are fundamental to the market performance.
That didn't feel sincere. I'm not sure if that was the intention or not. I know you've got some bonds to sell too, 3-year, 10-year, 30-year. Do you want to try and pitch them now?
You want me to be like the snake oil salesman? You got some bonds to pitch?
Got some 3s, got some 10s, got some 30s.
Yeah, well, we've got some bond auctions. And to me, that is important also at a time where you have a market that's attenuated to any move potentially in terms of understanding the long-term trajectory of inflation. Is there a concern about sort of a stickiness perpetually? And it ends with $22 billion of 30-year notes on Thursday. How bad could that auction be if we get a hot CPI print on Wednesday?
That's a lot to look forward to a little bit later this week. Before we run away with all of that, we need to focus on this too. Just a little bit of a softer euro for you, negative by 0.6%, 107.38. French equities underperforming, bonds lower, yields up, spreads wider. Lisa, put it all together. What was the surprise over the weekend? In the polls, basically, we were expecting Le Pen to smash Macron. That's basically what we got. The surprise was that he then turned around and said, yep, snap election, just like that.
He wanted to test the true appeal in a broader legislative election, and he wanted to see if Le Pen's subordinates won, could they rule? And if they couldn't, could that really strengthen his support? It's a pretty big gamble. A lot of people weighing in on both sides. There's also this larger question of what is the alternative to the dollar and what is the potential consequence if the dollar continues to strengthen or even stay the same, as Kitchuk said, before, say, the political winds really heat up in the U.S. and all of a sudden then you have the weakening.
All of this setting the stage for the 27th French presidential election, just a few years away. Coming up this hour, Troy Gursky of FS Investments ahead of CPI and the Fed on Wednesday. Bloomberg's Josh Wingrove ahead of President Biden's trip to the G7. And Wells Fargo's Mike Schumacher on what's needed for a September rate cut. We begin with our top story. All eyes on Wednesday's CPI print and Fed rate decision. A hotter than expected May jobs report muddying the path to rate cuts and driving yields higher, leaving investors wondering is good news. Now, bad news. Troy Gursky of FS Investments joins us now for more. Troy, let's start there. The data on Friday, was that good? Was it bad? I guess the answer is it depends where you looked.
Yeah, and it depends on the asset class, right? Obviously, for equities or any economically sensitive asset class, it's incredibly good news. Now, clearly, equities have to fight higher yields, which led to a round of mini multiple compression Friday tied to this morning's futures as well. And given how elevated multiples are, again, 21.1 times forward earnings, the upside is capped as long as the inflation numbers stay relatively high. Obviously, for fixed income, as has been the case, continues to be bad news. Everyone that expected Fed to cut rather aggressively has been proven wrong yet again. So it's been a really tough spot to be in duration, and that we expect that to continue. And then we just don't expect any more meaningful multiple expansion at these relatively lofty levels.
Troy, before we get deeper into markets, walk me through what you expect on Wednesday in the news conference with Chairman Powell. If you point to the household survey, it says reach for the tin hat. If you point to the establishment survey, it says let's talk about higher rates. What do you think they will be discussing?
Yeah, I think they'll continue to stay they're data dependent and that the data is murky, as you highlighted this morning. Various surveys are painting different pictures of the economy, but the one thing that has been consistent is that the Fed is being very patient with forward cuts. We do expect them to cut 1 or 2 times by the end of the year because, as a lot of your prior guests have stated, the consumer has been softening. The labor market has moved from white hot to somewhere between warm and red hot, and you just don't have the excess savings left to continue to boost consumption. And obviously, wage growth has slowed down from very lofty numbers. So I think it's going to be data dependent. They're not going to overreact to any one survey, but ultimately, it makes sense to cut by 1 or 2 times by the end of the year.
Do you have a sense, just before we get into markets, on where the balance of risks right now in terms of potentially inflation overheating versus a recession? It seems like we've been whipsawing from week to week, depending on data that's been also whipsawing, with some people saying that the Fed's going to have to hike again next year in the face of inflation, and other people saying the Fed should cut aggressively because of weakness. Where do you fall?
Yeah, I think those are two extremes that are just unlikely, right? I mean, what we've been doing here is walking down a path of purging the economy of excess consumption capability, right? You had so much fiscal stimulus, you had so much excess savings, and it's taken time for that to gradually go away. So I'm not quite sure why people extrapolate a gradual softening of the economy to a hard landing. When you look at all the constituent parts of the economy, whether it's business, fixed investment, I mean, just look at the spends of the mega cloud scalers right now, whether it's residential housing, whether it's state and local government spending. And again, consumption has slowed, but there's nothing that appears to us that will drive unemployment higher at a fast enough rate to cause consumption to go negative. So the recession risk has dropped like a stone. It's not zero, but it's, call it somewhere between 1 in 10 and 1 in 5 the next 12 months. And then on the inflation side, the probability of the Fed hiking again, unless there's some type of dramatic supply shock again, is extremely unlikely. So the reaction function is don't hike, keep rates where they are as consumption continues to gradually cool, have 1 or 2 cuts by the end of the year, and maybe the second cut's pushed into 2025.
You said, why are people looking at these two dramatic situations? And part of it is because people feel uncomfortable. Part of it's because people are impatient, but part of it is there's a real sort of tension here with stocks making all-time highs in the face of a weakening economy. And the biggest stocks in the index have greater dominance and are swinging around like never before. Does that give you pause?
Yeah, I mean, clearly the biggest concern for listed equities is as fewer and fewer companies are public now, is the fact that you have a super narrow market, right? And whenever you have a super narrow market at these lofty valuations, not just the broader S&P, but obviously the magnificent 7 minus Tesla plus Eli Lilly are about 34 times forward earnings. What you're really concerned about is idiosyncratic risk, right? Something going exceptionally wrong with 1 or 2 of the market leaders. And one of the reasons I think investors feel that this environment's just been too good to be true, particularly for listed equities, is that you actually had the idiosyncratic risk in Tesla and to a lesser extent Apple this year. But it's been a have no fear moment, right? Because NVIDIA has turned into the greatest wealth creation machine mankind's ever seen, where you're growing revenue and earnings faster than market cap as market cap goes to $3 trillion. And then on top of that, you have these wonderful obesity treatment drugs, which are addressing, the biggest secular challenge for U.S. healthcare. So you put it all together, it's understandable why there's nervousness and caution. And clearly at these valuations, markets are priced for perfection. And you alluded to that 30-year bond auction going forward. That continues to be, in our mind, one of the most obvious endogenous risks, where we get a few sloppy options like we did a week or 2 weeks ago, and that causes yields to gap higher. And then you're going through another August to October event like we did last year, or to a lesser extent this April. So that's the most obvious risk, given where valuations and the trajectory of rates could be.
Troy, you say that's the most obvious risk. It was also the most obvious risk on December 29th, which is the last trading day of 2023. And NVIDIA has doubled again. Troy, I just wonder,
yes.
Are we having the right conversation? Are we asking the right questions?
Well, I think you are. I mean, look, I think the last 7 to 10 years, there's just been this transformation of the U.S. and even global economy from where you had more diversified sources of growth and revenue and earnings to one where it's become really a winner-take-all economy, right? Where all the wealth flows up to the U.S. champions. More and more companies have stayed private. There's fewer opportunities to diversify, within public listed equities, which is, one of the reasons the alternative industry has grown what it has. And so focusing on that idiosyncratic risk is very valid. It's just the strength of the growth has overwhelmed that. And, as I often say, one of the biggest surprises this cycle is that despite the Fed tightening at the pace they have and continuing to drain their balance sheet, albeit they're in the process of tapering, equity markets re-expanded from 15.75 to 21.1 times forward earnings during the most aggressive tightening cycle in history. So I think people are focused on the right things, but the flip side is that sometimes the underlying organic strength of earnings can overwhelm more broader macro concerns. And clearly, again, asset classes have differentiated. Equities should be outperform in a stronger economic environment with more persistent inflation. And fixed income should continue to struggle because the probability of forward hikes continues to drop, or forward cuts continues to drop, and obviously the magnitude has as well.
Got it. Troy, a lot to think about. Troy Gursky there of FS Investments. The S&P 500 year to date, Lisa, of 12%.
Did you hear what he had to say? Auctions. That is really important. We have 50...
Out of everything he said that we need to unpack, that was the thing that jumped out.
Well, to me, it's the duration risk, that the upside risk to bond yields is the biggest risk facing equity markets, and that, frankly, just profitability is powered through that. And that idea, to me, is a really interesting one. I know FS Investments with Laura Rame has also been talking about the idea of stickier inflation, stickier yields. Question is, how long can people power through that? And is that the reality at a time where other people are saying, actually, it's a great time to buy bonds?
They're the only house saying it, that maybe these supply dynamics reassert themselves as the year grows older, we get closer to November and start thinking about policies a little bit more.
Yeah, although people are talking about, a Liz Truss moment or some kind of potentially catalytic moment that caused some sort of rise in yields. This is still a risk. I mean, that's sort of a key question to your point, kind of how you started the show, which is, what will Jerome Powell say in this news conference that could potentially move the needle? And that ongoing continues to be a concern at a time where he tilts dovish, he can't help himself, and that's been the most supportive thing for bonds going forward.
The 10-year yields are higher by another 2 basis points or so this morning, getting closer again to about 450. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. NVIDIA's 10-to-1 stock split will take place today. The AI boom has powered the company to huge gains of more than 140% year to date. The share price has surpassed $1,200. The valuation passed $3 trillion. And to that point, Goldman's David Kostin says that one of the key reasons for the split is to both increase liquidity and retail activity. Secretary of State Antony Blinken will head to the Middle East today, looking to push a last-ditch ceasefire proposal that has so far been dismissed by both Israel and Hamas. Blinken will meet with the president of Egypt before heading to Israel, where he's expected to meet with Prime Minister Benjamin Netanyahu. It's Blinken's 8th visit to the Middle East since the war broke out in October. Donald Trump has his first meeting with his probation officer today. Sources tell Bloomberg that the former president will do the interview virtually from his Mar-a-Lago estate. The officer will then submit a sentencing recommendation for Trump. The presumptive Republican nominee is scheduled to be sentenced by a judge in New York on July 11th, and that is just days before the start of the Republican National Convention. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, a challenging G7 coming up for President Biden.
I think it's an opportunity for Biden to show leadership, and it's an opportunity for the existing leaders of Europe to show leadership as well.
We'll get the latest from the team here at Bloomberg just around the corner from New York City. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This morning starts in France. Good morning to you. Focusing on France for all the wrong reasons for Emmanuel Macron. Yields are higher by 10 basis points here, approaching 320 on a French 10-year highs for the year. Euro weaker, negative 0.5%. Lisa, equities a struggle.
And what you pointed out was that this was not unexpected in terms of the gains by some of the more populist or far-right groups. But the reaction that Emmanuel Macron had to it about calling a snap election in the legislature raises a lot of questions about A, will his party win? And B, what will happen if they don't? Well, does it legitimize, to your point, the far-right party, or does it show that it can't govern, which is Emmanuel Macron's bet?
Busy, busy month coming up for European politics. Couple of dates for you. June 30, first round results. July 7, second round. British election in the mix as well. July 4th. More on that a little bit later. Under surveillance this morning, a challenging G7 coming up for President Biden.
I think it's an opportunity for Biden to show leadership, and it's an opportunity for the existing leaders of Europe to show leadership as well. They're going to have to actually explain yet again what's at stake, why it's at stake, why they're the better alternative. And that's not just Biden, that's the European leaders.
It's the latest with the G7 kicking off this week. President Biden facing challenges at home and abroad. Wars in Ukraine and Israel denting his polling numbers as U.S. officials look to finalize a $50 billion loan to Ukraine using frozen Russian assets. Bloomberg's Josh Wingrove joins us for more. Josh, just what is at stake for the president this week?
John wants to show that democracies can still do things. Of course, the G7 in recent years had sort of given way to the G20, where sort of all eyes were focused. Now it's sort of that they don't really get as much done in the G20 anymore. Russia, China really blocked consensus on that. So you've got G7 leaders, many of whom are unlikely to be there at the next meeting, or at least it's up in the air whether they'll be there at the next meeting. Of course, Joe Biden has an election himself this year. Kind of have this, kick at the can to try to do something in particular on Russia and Ukraine. That's where the focus is. You talked about the $50 billion, or at least $50 billion. It seems like there was progress on that over the weekend when Joe Biden was in France, spoke with Macron about this, indicated that they came to some sort of agreement, but hasn't given any more details. That, I think, will be the big top-line thing. But we're also going to see, and have seen in the G7 ministerials, including the finance ministers, focus on China and that sort of thing. The U.S., of course, is looking for other countries to follow it in some of the steps it's taken to add tariffs or restrictions on Chinese exports, in particular around sort of critical technologies and goods. So keep an eye on that. We'll be watching for China. We'll be watching for whether they get that deal on finding some way to squeeze cash out of these seized assets. It's genuinely a dispute over how best to do that, though.
Josh, traditionally, these are big opportunities in election years to demonstrate leadership, to act presidential. I say traditionally because these days, isolationism seems to be playing quite well with certain segments of the electorate right here in the United States. From your perspective, do you think this week is an asset for the president or a liability looking ahead to November?
I think time will tell, but I'm very sure that Joe Biden thinks it's an asset for him, and he will want to have it on show. I think he'll look at these results in Europe and see less the rise of the far right in certain countries and more the fact that the overall composition of the parliament seems to have not changed all that much, and that Ursula von der Leyen seems to have the inside track there. That's a leader that Joe Biden likes quite a lot. So I think he will see that as the middle more or less holding rather than the right ascending. I think we'll hear a lot about that. Of course, we'll hear the same next month at the NATO Leaders Summit here in Washington. He wants to put on a show. Remember, of course, Joe Biden and Donald Trump have very different views on this. Trump was not a huge fan of the G7, even less of a fan of NATO members that don't pay the 2% or spend 2% of GDP on defense spending. A lot of concern within those countries that if Trump wins, the status quo at the very least is not going to continue. So, we're going to see Joe Biden put a big banner up on it. We're ramping up, though, here. This election is really taking off. You're mentioning the European election dates. We've got a debate here, of course, John, in a few weeks. First debate between Trump and Biden. All eyes will be on that. The polling's still really tight right now. It looks like if Biden has a path to a second term, it runs mostly through the north. Could be a razor-thin election, so every moment matters, and this one will be about showing unity with the Europeans.
Josh, you said a couple of things that I want to dig into, that basically President Biden is putting on a show at the G7. Who is this show for, given that he has already the voters that are looking for some of the messaging that he's putting out there at this G7 meeting?
I think they're trying to remind voters what Trump has said he would do. A lot of polls have shown that people aren't really tuned in. Even in recent weeks and months when we talk to voters, They're not even sure necessarily who's running. So I think we sometimes get ahead of ourselves, sort of assuming when people check into the process. So I think he just wants to say that maybe there are voters out there who think that democracy is at stake, and that is his argument, or that might think that if he framed it that way. Now, there's reason to be skeptical about whether that's all that big a pool of voters, and there's polling that shows that the economy remains the #1 issue, and that any moment spent talking about not inflation is maybe a moment that some Democrats will scratch their heads over. It's a little bit up in the air. But Biden more or less wants to campaign on sort of American exceptionalism, America's standing in the world, whereas Trump has much more of an isolationist view, and you wouldn't see him necessarily wanting to trumpet the same things.
As we've been talking about voters on the show this morning, voters have really cared about immigration and inflation. Those are two of the biggest issues that they've been putting out there. From an economic perspective, and this is a big economic week, people also very much looking at both of those features, maybe for different reasons. How much do you expect what we saw from President Biden in terms of curtailing some of the asylum seekers at the southern border from coming in as sort of the opening salvo to limit inflation? In other words, inflation, we're going to see lower immigration regardless of who wins the election.
I think that's true. I think the hopes for comprehensive immigration reform are very, very, very low, regardless of what happens in the House, Senate, and presidency. So whether it's Trump or Biden, there will continue to be some restrictions at the border. But of course, Trump would go farther and has talked about mass deportation. So if the lens is economic and workforce, that is a big difference between the two. We're still watching to see how these changes that Biden has announced take shape. Some of our colleagues, including Nadia Lopez, went to the border last week, and there seemed to be a lot of confusion, a lot of people still coming in, not clear how quickly they will be removed or how quickly these changes are taking place. But immigration is a key one. Biden seems to have decided that he's willing to tolerate the risk from the left. Progressives don't like the moves he made, nor do prominent lawmakers, including Senator Padilla from California. He seems to have basically gambled that those people will vote for him anyway, and that there are voters in the middle that he can get by sort of taking action on the border, and has said that the U.S. risks losing public support for the very notion of immigration if it doesn't get a handle on things in a more orderly way. And so that's what he's doing there. They're both cracking down on it, but the measure to which is quite different. And so, when Trump is talking about deportations and that sort of thing, I think it's a big difference between the two.
Josh, the most important question this morning: why are you in Washington and not in the south of Italy? What went wrong?
I'm leaving in a couple days, but my Oilers, Jonathan, have game 2 here, so I want to, don my jersey tonight and be sure
you make it happen
before hitting the road.
Josh, thank you. Josh Wingrove of Bloomberg down in Washington, D.C. That's the trip everyone wanted to go on.
Yeah.
But for the last 12 months, we've been talking about that trip.
And he basically is going to go, but late, so that he can watch the game and put on his jersey.
That makes sense.
Yeah, well,
and then stay a little bit longer, extend the weekend. Got things to do.
What did we do wrong, John?
Well, why are we here? Don't know. I think it was TK. TK 12 months ago talked about how we need to go to the G7 in Italy.
It's going to be important. Yeah. We care about Ukrainian funding.
Absolutely. Only Lisa could break down the sophisticated nature of this potential loan that they could come up with to tap into Russian assets.
Oh, yeah, it's fascinating.
I'll do it for you.
And implied interest going forward. Yeah. I'll do a detailed analysis. Do I get to go?
A chat with management a little bit later on why Bramo must go and why I must supervise and go alongside her.
We should have a poll. People write in if you think that we should go.
You can do one. Sure.
If
you make that happen.
Gets a certain level, we get to go.
See if management comes along for the ride. I doubt it. Coming up, Apple set to unveil a suite of AI-themed features at its developer conference. That stock is positive, a third of 1%. That conversation just around the corner.
authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
More on what the new iPhone's going to look like in September. Seconds away. Don't miss that. Equity futures on the S&P 500 negative by 0.1%, just a little bit softer here. On the Nasdaq, we're down by 0.04, with a fantastic jobs print on the headline number with a big asterisk. And we'll talk about that asterisk in just a moment. Equities were down by only 0.1%, even with this move in the bond market. So switch up the board and get to the bond market. A double-digit basis point move at the front end of the curve. We had a 16 basis point move higher on a 2-year on Friday. Add a little bit more weight to this yield curve again, up by almost a basis point on a 2-year to 489.30. Just pulling up the auctions on my Bloomberg terminal for you because Lisa gets excited about these things. ECO20 space US.
Today.
Yeah, and I've got it. Yeah, 3-year, 58 billion. Then we get 39 billion 10-year notes, 22 billion 30-year bonds, right? That's the lineup?
Thank you.
No, anytime.
That was
I'll
great.
do it on repeat for you.
Well, I mean,
of those maturities, which one's the big one?
Well, I think it'll be interesting. 10 years always the biggest, just because people tend to see that as sort of the preeminent gauge of longer-term inflation expectations. But that's Tuesday. So I actually find it more interesting to see what happens with the 30-year bond auction of $22 billion of notes on Thursday, because that comes after what we get with CPI, after the FOMC rate decision. So after PPI, you could potentially, if there are hotter than expected reads, could that be messy? Could that lead to what Troy Gajewski was talking about?
Interesting, just a bit more investor pushback.
Well, I mean, if you get a hot prints, you can imagine that that will be the true gauge of just how concerned people are, that they don't understand the underlying inflation. Because granted, people come on the show and it's various shades of I don't know. I mean, basically, that's what everybody keeps saying. You know, lack of certainty is sort of the phrase du jour, and this is sort of what you're going to see in terms of just how volatile some of these auctions can be.
CPI, Wednesday morning. We'll get to the week ahead in just a moment. Let's just turn the page and go to the FX market. The euro, a little bit weaker this morning. We're negative by 0.5%. Euro dollar 107.46. The French snap election. Let's sit on this just for a moment. Lisa, we'll go through the details of this, but were you surprised to see a much weaker euro off the back of this news over the weekend?
Given the fact that it was exactly in line with projections, yeah. And actually, it raises the point that a lot of people have been making, which is you can't really bet on elections, on politics. It's like staring into the sun. But then it happens, and people do respond. It is a market-moving event. In this case, it was because of what Emmanuel Macron did. He basically gave the far-right party a chance to legitimize their governing abilities. But at the same time, it does feel like people are not actually pricing in some of the projections in the polls more broadly with elections.
Based on how many elections there are this year, we'll be staring at the sun a fair bit, right?
We could go to Puglia and do that.
In Europe, we should go to Puglia and do that.
The sun is much brighter there.
Should be covering the G7, shouldn't we? I'm sort of speaking directly to
one person.
One person. Why aren't we doing that? Under surveillance this morning, counting down to Wednesday's doubleheader. We'll get the CPI print at 8:30 Eastern Time, a Fed rate decision at 2 p.m. and Chairman Powell's news conference 30 minutes later. This is a three-part act. It's the statement, the news conference, but also the outlook, the projections. We did a survey here at Bloomberg. 41% of economists expect the Fed to signal 2 cuts in the dot plot for the year. An equal number expect the forecast to show just 1 or no cuts at all. That just gives you a sense of the expectations going into Wednesday.
And shaping those expectations with his statement of economic projections. And Deutsche Bank talked about how incredibly rare it is, first of all, to get CPI and a Fed rate decision on the same day, how much the Fed's going to have to readjust the message depending on the CPI that comes out after already having a full day of their meeting, but also saying that given where inflation expectations are, that could really shift the tone of the meeting in a more substantial way.
You'd have to imagine, and we said this Friday, Neil Kashkari feeling pretty good going to this two-day meeting that starts tomorrow?
Well, Neil Kashkari, yeah, he thinks that maybe we should not cut it all, and that next year he should potentially see either potentially one cut or even a hike. But at this point, it just seems so uncertain because of a lot of the weakening economic data too. And that's the reason why we've just seen a complete lack of conviction on pretty much every guest that's come on this show.
Apollo agrees with him. SocGen agrees with him. Others agree with him too. Elsewhere in Europe, the latest political news. Far-right parties gaining ground in European elections. French President Emmanuel Macron calling for a snap legislative vote in a bid to fend off rival Marine Le Pen. This as German Chancellor Olaf Scholz's Social Democrats party suffers its worst ever results. Meanwhile, in Italy, the PM, Giorgia Meloni, notched a win. So Kashkari's going into this two-day meeting feeling good. Don't you think that the Prime Minister of Italy, Giorgia Meloni's going into this G7 feeling pretty good as well?
She's where the energy's at. And at this point, you have to wonder how much that shifts the tone of the G7. You know, we're talking about how President Biden's going to try to talk about the threat to democracy and have these very significant moments to really signal status quo. At the same time, you wonder how much of a stage Meloni gets and how much more attention she gets, how much more discussion there is about immigration, about inflation, about countering some of the dependence on certain nations for energy costs, et cetera. There are a lot of other issues that it would be very curious if they would address in a more comprehensive way.
I was hoping that we'd catch up with Anne-Marie tomorrow. I've just been told it won't be until Wednesday.
Oh.
You need a little bit of time to acclimatise, apparently, just to prepare, you know, to get used to your surroundings.
It's difficult when it's really nice and
not jealous at all. I'm going to do this for days, Let's talk about Apple. Developer conference getting underway in California today. The company said to unveil a suite of new AI-themed features, including text and email summaries, custom emojis, and a more powerful version of Siri. Bloomberg's Dana Wollman joins us now for more. Dana, wonderful to catch up with you. Thanks for being with us.
Thanks for having me.
I am absolutely clueless as to what to expect on this iPhone later this year. Can you walk us through in very simple terms how this thing is going to change?
So Apple, belatedly, many would argue, is going to be working artificial intelligence into just about every aspect of the user experience. That includes summarizing notifications, web pages, emails, enhanced photo editing features, and as you say, AI emoji, where if you're typing and maybe there isn't already an emoji that fits what you're describing, it'll make it up on the fly. At least that's what we've reported. And you can see I'm a little giddy. That sounds especially cool to me, at least.
Do you think Apple is making it up on the fly?
Do I think Apple is making it up on the fly?
Are they very behind and trying to launch things when maybe they're not ready to be launched?
I think they're certainly playing catch up. And I think today's offering is expected to be pretty robust. I think out of a roughly 2-hour presentation, our reporter, Mark Gurman, estimates this will take about half of that presentation. So plenty of features on offer. However, he also expects that they will be listed as beta when the software fully launches in the fall. And that is unusual for Apple. Usually what you see in the fall is really polished, final software, very few bugs. But this will be a little different. It'll be listed as beta, and users, more importantly, too, will be asked to opt in. So you won't be automatically looped into this whole AI ecosystem, this whole AI framework, if you're uncomfortable with it.
You know, it raises a question. How high is the bar to really start a new super cycle for sale, for purchases for iPhones, right? Is this enough to get people in the door, not that there really isn't a line outside the Apple store, but to make sure that they get summarized notifications or cool new emojis that are made on the spot? Do you get a sense from your reporting of how high the bar actually is to restart interest in purchases?
I think, and this is, obviously take this with a grain of salt, I'm not an industry analyst, just an editor, but I do think there is chances are fairly good of a super cycle of phones, especially if our reporting is correct, that the AI features will be limited to the very newest iPhones, which is a little unusual for Apple too. Historically, software upgrades roll back quite a few generations. But these features in aggregate do sound pretty neat. And I say that not as an editor, but just as a regular consumer. And I think it could indeed prompt people to upgrade, especially if they were already holding out. Maybe they had already paid off the installments on their phones. They were already ready. This could possibly be a notable enough upgrade. And we haven't even talked about the way that iOS itself is going to be getting a facelift. Beyond just the AI features, the look and feel of the OS is going to be different as well.
So I have to say, just because I'm a contrarian by nature, part of me wonders, first of all, to John's point, how much we could see another Microsoft moment, where they unveiled certain AI aspects before they were ready. And there were some pretty big snafus that raised a lot of alarms and brought a lot of bad press. But B, whether people are concerned it's moving too quickly without a real sense on some of the ramifications.
I do think Apple is going to need to discuss security really thoroughly in its presentation today, specifically how the data is handled when it's processed in the cloud. Historically, Apple has really talked up the benefit of on-site, on-chip, on-device processing. But for these kind of tasks, it's going to probably have no choice but to offload at least some of that processing to the cloud. So it's going to have to spend some time talking about the security of the chips that it uses in these AI servers.
Dana was describing me, someone who's paid off their phone, hasn't upgraded for a number of years, and actually over the weekend considered things and then thought, I might as well wait until September and see what they come up with. I'm also a person who's never used Siri, ever, literally ever, on my iPhone. Because all I hear is that it's absolutely useless, so what's the point?
Right, so the question is, how high is the bar for you, Jonathan Farrow, who's going to represent all of the people who have delayed their iPhone purchases? Here is your mascot. There is a question about whether what you just heard is cool enough for you to get a new phone, that it comes up with a sort of bespoke emoji.
So my issue is that FaceTime's just not working anymore for me, and that the headphones don't work either, that it's sort of cut in and out when you're trying to have a conversation with someone. It just sort of goes silent. Am I the only one who's experiencing this?
No, I've experienced it.
You've experienced it too?
Yeah, I have. But
is it a headphone issue, or is it a headset, a hardware issue, a phone?
Or is it an issue of just reception in a particular spot?
It's Wi-Fi, so it can't be.
Yeah, well,
it's
I don't
Wi-Fi.
know. I don't know if you know. Please write in also. But I think it's a good point, which is, in other words, people are used to using their phones for specific things. Is it really going to move the needle for them to be able to get new things? I think there's a subset of younger individuals who have their parents' credit card who,
this sounds close to home.
Try to get the new things.
What is it about Apple that just becomes a complaint about your personal life? And not just you, for me too. That's the company, right? I'm just hearing from a producer, AirPods don't work on FaceTime. There's confirmation.
Interesting.
2 sources.
All right, there you go. Then it means it's true.
Dana, thank you. I'm not sure if Dana would sign off on that one, but yeah. Dana Wallman of Bloomberg on the latest with Apple. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. On Sunday night during a rally in Las Vegas, Donald Trump said that he would scrap taxes on tipped earnings for hospitality workers if he wins the presidential election. The pledge signals Trump's bid to appeal to Nevada's mass service industry, dominated by young workers and people of color, 2 groups that he is trying to focus on ahead of the Republican National Convention in July. Former Israeli Army General Benny Gantz has resigned from the country's emergency government over the weekend. Gantz has been critical of Prime Minister Benjamin Netanyahu's handling of the war with Hamas. His departure won't cause the ruling coalition to collapse, but it does leave the government without a moderate voice, and it makes Netanyahu more reliant on his right-wing coalition partners. The cost of owning a home in the U.S. has increased 26% since 2020. Expenses including taxes, insurance, and maintenance have all soared. The past 4 years of inflation dealt the biggest blow to homeowners in Utah, where expenses surged 44%. And that's your brief. John.
Danny, thank you. More from Danny again in about 30 minutes' time. Up next on the program, aiming for a soft landing.
I think Fed cuts, preemptive cuts, are essential for the soft landing to continue. If inflation doesn't let them do that, I think then we're looking at a bigger slowdown.
That's up next. This is Bloomberg.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Live from New York City, equity futures here just about unchanged on the S&P 500 this Monday morning. We're going nowhere. Yields are a little bit higher by 2 or 3 basis points after a double-digit basis point move on Friday, getting closer to 450 again at 446.31. Under surveillance this morning, aiming for a soft landing.
Look at market pricing. We're priced for a soft landing. So what's the risk to that? A recession, I would argue, or a bigger slowdown. The Fed can cut, but if they cut what's priced in, what essentially the market's calling for, you're not going to get any further easing in financial conditions. So I think Fed cuts, preemptive cuts, are essential for the soft landing to continue. If inflation doesn't let them do that, I think then we're looking at a bigger slowdown.
So here's the latest. Traders pushing down rate cut expectations following a stronger than expected May jobs report. Investors now bracing for Wednesday's Fed and CPI doubleheader. Mike Schumacher of Wells Fargo writing this: the Fed needs to see 2 to 3 consecutive good inflation reports before easing. I think this unfriendly jobs report resets the count to 0. So this means a lot of data have to behave very nicely for a September ease to be in place. Mike Schumacher joined us now for more. Mike, wonderful to get your perspective on quite a choppy week last week. 2 very different stories. We had weak data and bonds rallying, finished the week with strong data and bonds selling off. Mike, overall, a noisy journey to absolutely nowhere. Is there anything that you see that tells you that sometime soon we break out of this range?
No, really, it's all about inflation, John. So the Fed needs to see inflation behave a bit better and at least stop throwing questionable numbers out there. So last week was bad, frankly, on the inflation front. We get a huge number coming up on Wednesday that's much more important than this past Friday. Nonetheless, the inflation story dominates, and I think until that really goes in a better direction for the Fed, you're going to see this messiness in markets. You see a lot of disarray at the FOMC. I recognize it's been the blackout period, but that'll change in a couple days. We'll hear a lot of people weighing in. And it's going to be very difficult for policymakers to get excited about a rate cut unless CPI actually is decent.
Well, let's start Wednesday morning. What do you define as decent, and what would you expect to see Wednesday at 8:30?
Yeah, core can't be worse than 0.3. So 0.25 would be nice, unrounded, but 0.3 is a relatively poor number, and 0.4 is just a Fed killer at this point. So anything notably above 0.3 is a real problem for the Fed right now.
Given the fact that you think that that would reset everything to 0 rate cuts this year, how much does that affect your macro call, particularly on risk assets, on equities, on some of the riskier credit that's rallied disproportionately this year?
Yeah, Chris Harvey is still fairly bullish, so I'll defer to him. As far as more broadly thinking about risk with respect to high-yield bonds, things like that, the Fed keeping rates high is pretty tough in the longer term for credit. So I think it sort of has an erosion type of an effect. People look at carry, say, well, it's become more negative. It means maybe in the very near term I want to buy credit, but also it increases the chance of defaults going up. So I think in the longer term it's a negative for risk. You're probably not going to hit a tipping point. So if CPI does come out at 0.32 or something on core on Wednesday, is that the death knell for risk? I doubt it, but it's a negative in our view.
Given the fact that you actually think that there's a quite considerable bar at this point to be crossed on Wednesday with CPI and then the Fed messaging, do you think it's important? And this seems like a silly question, but we started the show with a guest who said it's kind of a non-event. Do you agree?
CPI is a non-event?
CPI
no,
and then
the market
and then
didn't
the
get
FOMC.
that notice. So, no, that's clearly not a non-event. I think that's a huge event, frankly. So CPI has been the biggest market mover for better part of the last 2 years, it's not going to change on Wednesday. A big number either way. So something like a 0.2 or a 0.4, markets will go bonkers. Now, as far as the Fed commentary itself, that's the secondary event in our view. The Fed's not going to move Wednesday, that's no secret. Yeah, it might tweak the dots a little bit, big deal. But the bigger story is CPI. Does it really change the chance in a meaningful way the Fed really could cut this year? So the market's priced for 30-odd basis points. It's come way down, as we all know. CPI might put the hammer in that. That's the story. It's CPI Wednesday morning. It's not really the Fed.
Can you define bonkers? I mean, what asset class do you think is going to move the most, and what does bonkers look like?
Sure. Think about rate moves on Friday. So we had 15-plus basis points and a bunch of the on-the-run treasuries. If you get CPI coming in, let's say at 0.2, so a very good number, I wouldn't be surprised at all if something like the 10-year treasury yield drops 15 basis points in the session, 2 years down 20 basis points. That's a big number. Those are big numbers. And if you flip that and say, well, okay, instead of 0.2, let's say we get a 0.4. Do we get a somewhat symmetric response? Probably fairly close, I would guess. So something on the order of 15-odd basis points if the miss is 0.1 either way in the 10-year. That's a big number.
Mike, you've said for a while that when we start pricing in rate cuts properly, it won't just be one or two, it will be a lot. Do you still stand by that? Do you still lean away from this sort of mid-cycle adjustment argument?
I do. So it's interesting, John, and I think here is a key point. You've got to differentiate with the Fed or any other central bank for that matter, what it actually does versus what the market prices. And we think the market's going to run with it whenever that first ease happens, whether it's probably not July, but maybe September, November, December, who knows. Right after that, we think the market prices a lot more easing. And just to give you some context, if you look at market pricing right now, from September of this year to September of next year, forwards imply about 90 basis points, maybe 95, differentiation in SOFR. And history would tell you that's probably 225 to 50 basis points. So we think the market could price probably not another 125 basis points versus forwards, but perhaps 75. That would be enormous. So yes, we stand by that story. We think the market's going to run ahead of the Fed whenever that rate cut happens to happen.
Well, let's push that through the yield curve. The 2-year at the moment on my screen is just short of 490. We're about 489. The 10-year at the moment is about 446. So we've got a 2-year minus 10-year in the negative 40s. Now, Mike, you know what the consensus trade was at the start of the year. The consensus trade at the start of the year was bull steepener, let's go, this Fed's going to cut interest rates. Is it still too early to put that trade on?
It's probably too early to put on steepeners, John. What we think, though, is that when the Fed actually comes in, you want to put on long-duration trades. But in our view, clients are best off waiting. Trying to guesstimate that first move by the Fed, it's been a losing game. We tried, we missed. Others have tried, they've missed. The Fed's tried, it's missed. So if you look at historical moves, and I recognize you can always make the argument this time is different, but still, usually the long duration trade does well for a couple of quarters after that first rate cut. Curve moves, not so much. So our advice to clients has been pretty simple. Don't try to estimate or guess or whatever you want to call it when the Fed is going to move. Wait for that actual rate cut, then get long duration.
And then you think year-end we're in the threes, right? Sort of high threes on a 10-year?
High threes, maybe low fours, 40s, 440 right now is the forward rate. I think probably low fours is the right call. So 4-ish plus or minus 10 to 15 basis points. That sounds about right to me.
I'm still thinking about bonkers, and not just because it does fit into the conversation you've been having with John.
Hey, it's Monday morning, come on.
Well, I mean, it's a bonkers morning, it's a bonkers week. You know, John was talking about with sort of where this sort of leaves you with bond bets is an important one. I want to go back to just the moves that we've seen and how volatile things have been intraday. The fact that we've seen these 20 basis point moves, even though you expect maybe, you know, a 30 basis point move by year end, it's how we get there. Does it worry you that we've seen such massive swings in the benchmark rate that sets the valuation for a broad swath of financial instruments?
What I find interesting, actually, is that we've seen such big moves, and as John noted, they effectively canceled themselves out last week. So a ton of choppiness, call it intraday and intra-week, and yet not going anywhere very rapidly. That, to me, is a bit troubling. People don't really know how to read the tea leaves just yet, and that's why I think each subsequent inflation print's getting more and more important. It probably should be the opposite. This stage of the cycle, you would think every data point would become less relevant because the path would be clear, but it just hasn't worked out that way. So I do worry about this idea that markets are really volatile day to day, but if you look at week to week or month to month, not as much.
Mike Schumacher of Wells Fargo. Mike, appreciate the update. Thank you, sir, and great framing at the end of that conversation with Lisa. If you think about last week, if you were at work every single day, Monday through Thursday, it was like the economy's slowing down. You'd have a completely different picture of the world if you took the whole week up and came in Friday morning and just looked at the jobs report. Just hard to reconcile Friday's data with what we'd heard the rest of the week.
It just raises this question, who's participating in the roller coaster? Are people changing their narrative daily? Is it a bunch of algos? Is there added fragility to the market because of how much things have been swinging? You know, you talk about potentially getting down to 4% by the end of the year on a 10-year, but the path there is so dramatic that it actually looks quite different. And in the process, does something break given how instrumental this rate is to a broader swath of the market?
Speaking of really, really sensible framing, this from Ian Lingen, good friend of this program over at BMO. Ongoing resilience on the jobs front won't in and of itself delay a Fed cut, but it does remove employment as a potential trigger for a reduction in policy rates. Said differently, he goes on to say, the FOMC will still see 4 additional CPI prints between now and September, and that decision, leaving a Q3 rate cut as a very real possibility in the event the inflation data begins to conform with the Fed's targets. So Andrew Hoddenhorst, I think, is out at September. I think Alan Zettner and Morgan Stanley out at September. They probably agree with that sentiment this morning.
The idea that the conviction that inflation truly is coming down will take more than just Wednesday. And that, I think, is what a lot of people were saying when they said that was the sound of the door slamming on a July rate cut, because there just isn't enough data to really give Fed officials confidence.
You know, for the record, it was actually Lisa's hand sort of like banging the table.
I know, and I know. I saw your I saw your eyebrows just kind of go up. I couldn't help myself.
No, my eyebrows were up on the number. I was just like, whoa.
You just were more restrained and polite than I was. He was just like banging on the table.
Andrew Hoddenhorst in the city trading floor exiting and just sort of slamming the door. There goes July.
It's a very visual, kind of visceral response. It was a surprise, and that's the reason why Peter Scheer kind of came out and said it was the best of times, it was the worst of times, it was a confusing time. Why are we doing it this way? And I think a lot of people are questioning why the data is being written.
You know, we both said Friday morning going into that print, as soon as the show started, whatever the number is at 8:30, it won't settle anything. Won't settle a single debate. And that's what it felt like over the weekend. In fact, I'd say it poured more fuel on both debates through the weekend.
That's what I was going to say. Not only did it not give clarity, it actually widened some of the debates that continue to this day. So stay tuned. We've got more of them.
Andrew's not an aggressive guy. I can't see him, like slamming doors.
No, but he might have just sat there being like, which would have been the equivalent.
Yeah, he's like quietly frustrated.
Quietly just imploding.
That's Andrew Hoddenhorst,
yeah,
for sure. Coming up, Sarah Hunt of Alpine Saxon Woods, Vijay Rakesh of Mizuho, BlackRock's Amanda Lynham, and Mark Zandy of Moody's Analytics. From New York, this is Bloomberg.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, be some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
If you're hoping for weak payrolls so the Fed may cut, you're really trying to thread a needle there.
I think the economy is slowing, but there's still pockets of strength.
The Fed can cut, but if they cut what's priced in, what essentially the market's calling for, you're not going to get any further easing in financial conditions.
They won the battle on inflation. They don't want to lose the war on the soft landing.
There's no way they can cut or signal a cut in July with this data.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Slamming the door on July. This was Citi, surprisingly strong job growth. This was JP Morgan, the recent momentum in jobs growth. It was all about a blowout payrolls report. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now with equity futures on the S&P a little bit softer by 0.1% this whole week, Lisa. The first 2 days, it's all about inching closer and closer to Wednesday morning.
And the run-up really is going to be what is the threshold in order to tip the Fed toward even cutting rates as soon as September, because it seems like the bar has gotten higher. It seems like employment is not giving them the reason, so it has to come from inflation at a time where a lot of people are questioning the models. Yes, you're going to get that. We're not going to resolve that. But the reality is that rents aren't coming down as quickly as people think, and a lot of consumer sales are still going well.
I'm not just questioning the models, we're questioning the data still from Friday. We shared this quote from Peter Cheer of Academy Securities a little bit earlier this morning. Worth sharing again. The establishment survey makes it look like an incredibly strong and healthy labour market. There's another survey, the household survey, makes it look like a very weak labour market. This is what Peter goes on to say. If we pick and choose the data to look at, it's the best of times. If we look at the other data, it's the worst of times. That's the issue right now for a lot of people. Not just is good news or bad news or bad news for stocks, whether the data is actually good or bad.
Well, and this goes to what some people would say is the K-shaped economy, the idea that there is a swath of the consumers, and swath is my word of the day, congratulations, that is not doing very well, and then that there's a whole cohort that is wealthy and just living high. So that's that raises a deep question if that's really what explains the dissonance. Other people saying that there just haven't been as many responses to surveys post-pandemic. They haven't really gotten as clean of a read, and that's why revisions have been so important and so significant in all of the subsequent months.
We talked talked a lot about the call from Citi. Andrew Honhorst and the team looking for this weakening in the labour market. They just published jobs data divergence deepens. The establishment survey shows 2.8 million jobs added over the last year. The household survey shows less than 400,000 new jobs over the same period and a steady rise in unemployment in recent months. How much weight do you put on one over the other if you're on the FOMC and you've got to talk about the labour market in the news conference on Wednesday?
They could probably say there are signs that there has been a sustained loosening in the labour market, which is welcome. At the same time, there's enough strength to keep the economy going. It's all good. Inflation's really going to be the focus. They're not concerned about the economy falling off a cliff, but they are sensitive to that, basically giving you nothing that you really want to hear, which is essentially where we've been, which is the reason why we've seen such great intraday volatility in a lot of the macro signals. And yet, at the end of the day, people are just sort of frozen in place.
That was the real promo for 2:30 and the news conference with Chairman Powell on Wednesday. Probably what the opening statement's going to sound like. Equities right now on the S&P just about unchanged. We're negative by almost 0.1% on the S&P 500. The scores in Europe, not good. The euro is negative by 0.4%. French equities are struggling. The French bond market is struggling. Lisa, there's a political element, a dimension injected into European assets this morning.
The European parliamentary elections came in pretty much in line with what a lot of the polls said, which is essentially a shift away from some of the centrist, classic Democratic parties and toward some of the more far-right constituents. The question is, what's the significance? Well, Emmanuel Macron answered the question by saying he was going to hold a snap election. On a larger scale level, from a market perspective, how much does this show that election risk is not sufficiently being priced into assets because nobody can price in exactly how things are going to transpire, but that it's still a risk? And that, I think, is something that really I was interested in over the weekend.
Because it's hard to gauge the outcome from the outcome. And we saw that over the weekend. We knew what the outcome would be based on the polls, and if we'd said that's how this is going to play out, would you have guessed he'd do a snap election? Same, I think, applies to the election that's going to take place here in November. If I can tell you who's going to win, do you really know what they're going to be able to do over the next year or so? I think that's tremendously difficult to do, which is why we've said repeatedly on this show, we're flying blind into 2025. We really are.
And we don't understand what the reaction will be in the subsequent days and weeks of the election. Will it be determined? Who will respond in what way? Things that transpire from the outcome that we cannot predict, which is the reason why people are saying you need to hedge in certain ways, but no one's making a massive call one way or another.
Super, super complex stuff through the next 12 months or so. Coming up this hour, a little bit more straightforward for you. Sarah Hunt of Alpine Saxon Woods on what May's payrolls report means for the Fed. BlackRock's Amanda Lynham on why she expects a shallow rate-cutting cycle. And we'll catch up with Mark Zandi of Moody's Analytics, looking ahead to CPI on Wednesday morning. We begin with our top story, bracing for the Fed's two-day meeting. Sarah Hunt of Alpine Saxon Woods saying this: just when you think you can make a case for a summer cut, in comes the jobs number and takes it off the table. While that noise we all heard is likely the sound of the door closing on July, the inflation numbers will add or detract to the evidence being used by the competing yes, they should, and no, they shouldn't camps. Sarah's with us for more. Sarah, good morning to you.
Good morning.
Never mind good news, bad news. What was Friday? What was that?
I think it was mixed news, right? You start to have all these discussions about the differences between this survey and that survey, and can we count on this, and what is the birth-to-death model doing? I think it just is indicative of the fact that it's a confusing market, and I think that that is on the labor side, certainly, and I think that that's part of what's coming into play as we go forward. We started off this monster rally when the Fed basically said at the end of last year, or the October of last year, we're done raising rates, there's going to be an easing cycle. People built in a ton of easing, and now people are looking at maybe taking that away. And I thought that Lori Calvasina's note this morning was really interesting on, if we don't get one at all, you've got some weakness in the equity market.
I know Lisa's got thoughts on that, but before we get there, if the payrolls report slammed the door shut on July, can Wednesday morning reopen it?
Wednesday morning could reopen it because, as a number of people have noted this morning, it's not just the labor market that the Fed is looking at. If the inflation really looks like it's coming down, but to your point earlier, the housing market is not getting any better. Rents are not coming down. They're not looking a whole lot cheaper, at least not in urban areas. So I think it could, because you have that discussion of, are we cutting rates or are we normalizing? And obviously the market's going to take any cut as a start of an easing cycle. But if they can do something like the ECB did, which is basically say, we're normalizing, but we're hawkishly normalizing, and we're not going to cut, don't look at this as a cycle. It could certainly open it, but I don't think to July. I think it opens it later in the year.
On the flip side, if we get a hotter than expected CPI print, you were talking about Lori Calvasina's call, this idea that if there are no rate cuts this year, it could cause an 8% decline in the S&P 500. What if Jensen Huang comes out later this week and says that he has a new development that's going to build robots that do our dishes and take care of our children? Could that totally change any kind of sell-off?
Well, I think that there's already been a bifurcation in what a sell-off means. NVIDIA has not been part of any of that sell-off. You've seen other tech sell-off in ways that NVIDIA has not. There is a secular story there that is difficult to say that whatever is going on with the Fed is going to be important for that piece of technology. But there's also a big future element, and I think that that's what people are starting to recognize, is that you have to really go further into the future to try to monetize this, unless you're NVIDIA and you're selling them the chips right now. So there's a little bit of a thing going on right there where there's a secular story in one part of technology, but a market story in the rest of technology.
And do you believe that we're currently at rates that could cause the market story to gain legs? Like if we stay here, for example, in the market, I'm not just talking about Fed funds rate, that could really crimp how people understand forward-looking profits for a lot of the companies in the other 493.
Interestingly enough, I think it's almost less about profits as what it does to things like the housing market, which is still pretty stagnant, and what it does to people who have been waiting for a chance to refinance, because the idea was we're going to hike, we're going to go very high, then we're going to come down quickly. That's not happening. So there's a lot of extend going on in some of the fixed income markets. And I think that whether or not the stresses start to be a part there, I'm less worried about the larger cash-rich companies on whether or not a higher interest, a 5% versus a 4.75 or 450 makes a big difference. But if you don't get a cycle coming down, there's a lot of areas where I think that there's some tension in refinancing.
So let's get into it. Places you want to be, places you want to avoid. What are they?
Well, I think you need to be in the part of the technology sector that's quite clearly throwing off buckets of cash and doing really well in almost any environment. I think it's hard to say that that's a place you want to stay away from. The oil picture just got more difficult for energy, and I think that that's still something that is throwing off a lot of cash, throwing off a lot of dividends. You've got good buybacks there. Retail's very difficult right now. You've seen a bunch of retailers come out and say, you know, year-over-year sales are not doing that well, and we're kind of worried about the next couple of quarters. So there are areas where it's quite clear that there has been a slowing, and there are areas where there may be some acceleration, but the overall economic picture is going to weigh on some of those materials and energy kind of stocks. Some of the industrials are doing quite well and going to continue to do quite well. It's very pick and choose right now.
You hinted at something, that the longer rates stay at these levels, there could be some real credit stresses that percolate into something different. Can you give us a sense, walk us through what that looks like? How severe could that look? Is that a credit crunch? Is it a sudden plunge? Or is it just sort of a slow bleed on economic growth that just becomes more and more evident over time?
So I think that one of the reasons that you've seen, I mean, there has been some equity volatility, but not the kind of volatility you would expect given some of the things that have gone on with interest rates over the last couple of years, is that we've had all these government programs that came through in the financial crisis that people now look to say, you know what, if there's a really big problem with interest rates, there's going to be some sort of program to help them, right? So the whole issue with the banks that started last year, where the Fed said, okay, or Treasury said, you can go put us collateral at 100 cents on the dollar, even though rates have gone up and that collateral may not be worth 100 cents on the dollar. There are a lot of programs to deal with that. So I don't know that it's as much of a crisis as it would have been in past eras where you didn't have a kind of backstop on some of that. So I don't know where that goes, but you've seen commercial real estate have problems. You've seen even apartment housing. There's certain parts of the real estate market that are really showing some stress, and those are long assets. And a lot of those were financed at times where now if you have to refinance anything, you're looking at a much bigger number. And if what you paid for that asset is now problematic relative to where interest rates are. So I think that there's a question of what those assets are worth, but I also feel like there's an underlying feeling that there will be something if it gets really bad.
So just to sum this all up, and John was asking what you like and what you don't like. You do like big tech, the companies that are just generating bucket loads of cash. Consumer cyclicals are a little bit questionable. How cautious are you, given that you just don't have visibility at a time when you also are charged with generating alpha?
Well, it's tough because you have a multiple situation that, I mean, if you take the, you know, to Peter Cheer's point, the top 10 stocks, 35% of the S&P, but you have a multiple issue in some of the other areas. And I think you have to be careful both about what you pay and what everybody's balance sheet looks like, right? This comes back to cash. Am I generating cash? Because if you're not, and or if you have any refinancing that you have to do, you have to be quite difficult. It could be quite difficult, so you have to be careful about that. So I think that you just really need to pay attention to valuations in a way that we really haven't had to in sort of a while, because you just now have more vulnerability on what happens with the rest of the financial picture and what happens with interest rates.
We started this hour and we were talking about politics, and I could see you out the corner of my eye nodding along. 25. Have we got a clue what the next year has in store for us?
We do not.
How difficult is that as an investor?
It is difficult, but if you take the politics out of it and you say how much has the regime changed in terms of what that means for the equity markets, as long as you're not radically changing tax policy or you're radically changing a lot of the tariff policy. I mean, there was supposed to be a big switch when Biden took office about what was going to happen with China. It didn't really switch that much. There may be a change in immigration. We'll see what that could happen to the labor markets if you get a change in administrations. We don't know enough yet to start trying to figure out what that playbook looks like. And I think that's going to be very difficult to parse.
So do you shorten the time horizon, make really tactical calls, or just assume that things carry on as usual and there's no big change?
I think we're always looking for a longer picture, right? We're not very short-term traders. We're looking for a longer picture. This goes back to, am I generating cash? What does my balance sheet look like? What is the economy going to do? You look at the macro picture more, because the political picture is going to change, and we just don't know how that's going to change.
Sarah, this was great. Sarah Hunt of Alpine Saxon Woods. There is a lot we don't know about next year, right?
Which was, how do you have conviction to then make a bet? It's, you just have a slew of things you don't know. All right, now go, buy.
NVIDIA. Just seems to be the conclusion.
But that's actually exactly it. Again, this goes to concentration risk down the line, but for the moment, that seems like the sure bet.
It's a feature. It's an ingredient in the story, that's for sure. Equities right now in the S&P just erasing this morning's losses, almost unchanged going into the opening bell. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. To the point of politics, the euro is weakening this morning by about 0.4% versus the dollar. Meanwhile, French rates have hit their highest level of the year, with far-right gains in the European parliamentary election causing French President Emmanuel Macron to call for a snap election. Sonia Martin, who's the head of FX and monetary policy at DZ Bank, said the results reinforce her expectations for euro parity.
In case Trump wins the election, euro dollar is going to go to parity. And of course, that trade just gets more attractive when we have a situation in Europe, which is looking more and more complicated. That will make a downside euro dollar trade more attractive. And I think if we were to get this kind of scenario where things go downhill here and, we get Trump in the White House.
She went on to add that Trump White House makes sub-parity more likely. Martin spoke to me earlier on Bloomberg Brief, which are weekday mornings at 5 a.m. Eastern. Apple's Worldwide Developer Conference gets underway in California today, with the company's advancements in AI set to be the dominant theme. Apple, for its part, is expected to unveil a new suite of features that it will be calling Apple Intelligence. It will provide users with voice memo transcripts, custom emojis, and summaries of text and emails. Apple is also planning a more powerful version of Siri. Donald Trump is back on the campaign trail. He held a rally in Las Vegas last night. The presumptive Republican nominee said that he would scrap taxes on tipped earnings for hospitality workers should he win a second term in the White House. The pledge signals Trump's bid to appeal to Nevada's mass service industry, dominated by young workers and people of color, two groups that he's tried to focus on ahead of the Republican National Convention in July. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes. So this FaceTime AirPods thing is a real thing.
I guess so.
I thought it was just me.
Well, evidently not so much. Maybe they could fix that bug instead of coming up with Siri.
Shouldn't they be able to fix that?
I mean, you would think.
Do you know they brought a headphones company, Beats?
Yeah.
How's that worked out?
Not well.
Still can't fix the headphones.
Yeah, I have a confession to make.
Go on, make one.
I like the ones that you just plug into the phone that have the cords.
You're not alone.
I prefer those. They don't run out. They don't get fuzzy. They don't have to be charged. If you forget, it's not a problem. Just stick them in.
Isn't that a Gen Z thing? Aren't they doing that? Ben Laidler this morning, didn't he have
maybe
headphones?
I'm just, I'm old school. What could I say? It's refreshing to me.
I'm on board. I used to like that because, you just used to pretend you're doing stuff. And it was very visible.
Oh, yeah.
You had the cable. Busy. Don't talk to me.
Stop.
Got the headphones in.
Come on.
They know. It's not a secret, is it? Up next on the program, the morning calls. Plus, Mizuho's Vijay Rakesh as NVIDIA's 10-to-1 stock split goes into effect. That conversation just around the corner. The opening bell about 1 hour, 13 minutes away, with equities just about unchanged on the S&P. This is Bloomberg.
Here's the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Live from New York City, welcome to the program. Equity futures on the S&P 500, just a touch negative, just a little bit softer. No drama this morning. And if you looked at the S&P 500, the close on Friday, Lisa, you'd say no drama at the close on Friday as well. You'd have no clue that 8:30 happened.
Yeah, basically what we're looking at is a market that's whipsawed on all of the potential economic data points because they have no clue and then ending up at the same place, which is the reason why long-term investors say they're not doing anything and algos are saying, but we need to do something.
I can't even say there's a trend in the bond market either, because we're not even back at 450 on a 10-year. We're at 444.93. Yields are higher by a single basis point. 2 years, a great story. Look at the 2-year from last week. Weak data, buy bonds. And then Friday happens, and the 2-year yield is higher on the week by a single basis point, even after the data we got on Friday, even with a 16 basis point move.
This is the reason why I care about the auctions. You've got $58 billion of 3 notes coming today at 1 p.m. Eastern. What happens if you get a big disruption that causes more volatility in the short term, in the long term?
That's some of the price action for you. Let's get you some morning calls. First up, Susquehanna raising its price target on NVIDIA to 145. The analyst highlighting confidence in a sustained and smooth transition as the chip giant switches from its Hopper to Blackwell AI platforms this year. Next up, TD Cowen also lifting its price target on NVIDIA to 140. The firm adjusting its EPS estimates and target on the back of the 10-to-1 stock split. And finally, Mizuho analyst Vijay Rakesh raising his price target on NVIDIA to 127, noting the company's continued AI dominance. Vijay saying this: NVIDIA continues to see strong opportunities with the Hopper, Blackwell, and Rubin platforms announced at Computex for 2026. Its 10-to-1 share split should create a more attractive entry point for retail investors and could provide additional share tailwinds. Vijay joins us now for more. Vijay, I just want to start with that final point, and thanks for joining us again, sir. Why is that important? Sort of the equity market snobs would sit around this table, Vijay, and say it doesn't matter, it doesn't change anything. What do you think it changes?
Yeah, thanks for having me on, John. So on NVIDIA, our price level is 1275 pre-split, so the 10-for-1 obviously accounts for that. Now, I think it does not absolutely change the intrinsic value of NVIDIA, but what it does is it makes it much more accessible for the retail side of the investing platform. So obviously, a $127 price target, $127.50 price target that we have, or post a 10-for-1 split, it makes it a lot, increases liquidity, makes it a lot more accessible to retail. And I think that is obviously an attractive proposition that management sees. And that's also a vote of confidence, because I think this is probably the second or third split that they've done in the last 5 years. So,
do you get the sense that other big tech companies are watching this in terms of doing their own stock splits going forward?
I think it's very plausible. I think, obviously when you increase, there is so much retail participation in the market these days. When you increase the liquidity on the stock, obviously makes it much more accessible. It improves the trading environment, I guess. So, but like we said, it does not change the intrinsic value of the company. The fundamental DCF or any valuation you do kind of stays the same, but it just improves liquidity, improves accessibility for the retail side. So.
There have been a number of papers recently written about whether NVIDIA is a bubble, at what point it could be a bubble, at what point it could fuel a bubble in other big tech shares. A lot of people making the counter argument that it's actually generating boatloads of cash, so it's not really bubble-icious. How do you understand, what's your parameters of really gauging when enthusiasm has gone beyond the realm of possible and likely for a company that seems to be going through the moon, shooting for the moon, but it can't continue forever?
Yeah, I think two key things to watch. I mean, if you look at AI penetration in the server side, it's still less than 10%. It's still about 10% of the market. So there's still a long ways to go in terms of AI adoption, not just at the cloud, CSP level, not at the hyperscale level, but back into enterprise and in a lot of other markets. So there's a long ways to go in that adoption. Number two, when you look at the whole AI market, it's almost a 1 trillion market today, and about 250 billion of that is, you'll see about 250 billion a year of basically brown scale investment, basically upgrading existing infrastructure, and an additional 250 billion of new AI investments. So that's about 500 billion a year of AI investments that are going to come through. And I would say also, don't forget, when you look at NVIDIA itself, number three, I would say, what they're selling today is Blackwell. That's only a $50,000 ASP product on an 8 GPU server. They are going to full stack servers in 2025, where the ASPs or the selling price of these servers are in the 1.5 to 3 million. So a very significant increase in their selling prices, and that'd be a big driver for the top line. So there's a long ways to go on this story. So
Vijay, I want to talk about concentration risk, and not in the S&P 500. I want to talk about the customer base. We know there was one customer that accounted for about a fifth of NVIDIA's revenue. UBS, I think, thinks that customer is Microsoft. Now, given the nature of their big customers, is that an asset, or do you think that's a future risk?
Well, I think you will see at any point, other OEMs step up. I mean, you're seeing Meta increase spending, you're seeing Amazon increase spending, you're seeing Google still on the come. But I think the new kid on that thing on the podium seems to be Tesla. They're definitely pushing on the XAI and the AI data center. So there is a lot of new orders coming from Tesla to NVIDIA as well. And you would also look at the whole enterprise platform that's still out there that's not really penetrated. So, back to the point, it's still less than 10% server shipments. You're seeing very strong demand, but on the supply side, there's always some limitations there. So you can't supply to everybody yet. So,
Vijay, awesome to catch up with you, sir, on a 10-to-1 stock split day for NVIDIA. Thank you, sir. Bloomberg data, we've got Microsoft, I think Meta, Amazon, Alphabet, 40% of the revenue base for that company.
So far, that's been a feature, not a bug, because those have been the companies that have been able to spend big money.
They got the cash. How long's the runway? Mandeep Singh of Bloomberg Intelligence keeps asking that question. How long is the runway? Up next, Amanda Lynham, Mark Zandi on This U.S. Economy from New York. This is Bloomberg.
reporter covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities on the S&P 500. Bramo not happy. We'll share that for another day. All right. Not criticising when you're going on vacation. It's a beautiful place.
It is a beautiful place. Are you
so sensitive about these things? All right.
Big deal.
Hour away from the opening bell. It's not a big deal. In the bond market, the 2-year looks like this. Yields repricing higher on Friday by 16 basis points, pulling back a single basis point this morning at 487.62. This just in from Goldman Sachs. We expect the dots to show 2 cuts in 2024. They go on to say, Lisa, we think the leadership would prefer a 2-cut baseline to retain flexibility, but a 1-cut baseline is a possible risk, especially if core CPI surprises to the upside Wednesday morning.
Do they want to surprise the market in some capacity? Do they want to sort of cast some cold water on this idea that they're going to be accommodative even without some sort of weakening in the labor market? That seems like the differential. If it's 2 rate cuts, that's pretty much in line with what the market's expecting. You can't imagine that there's going to be a really significant response. So that seems to be maintaining the status quo type of option.
You go to 1, you wonder what it might change. Let's go to foreign exchange. Dollar stronger against everything in G10 on Friday. This morning, the euro weaker again, this time by 0.4%. The weakness coming on the euro side of the story. Some political uncertainty for the Europeans weighing on euro dollar, back down to about 107.55, and that's good for where you're going later this summer, so that's a good thing. All right?
You're revealing too much. Yeah, it's true.
I'm not saying where you go.
I'm wondering, you know, if we could just get it down a little bit further, it would be even a better vacation. This is the reason why everybody is on a plane from the United States over to Europe, and actually, U.S. resorts are seeing the influence of that because they're not staying in the U.S. They're all going to Southern Europe in particular. I was just talking to some people about that.
20 nations in the Eurozone, I think, Bramo, so, you know, no one knows.
Yeah,
it's okay.
But the truth is they're all going to 2.
As they often do.
Yeah. That's where all the American tourists are going.
Always surprises me. Number 1 is France. Always surprises me.
Yeah, well, it's Olympics.
Number 1 for global tourism or something.
Yeah, but
I don't get it.
It's Southern Italy
because
this
when
year.
you get there, the French behave like they don't want you there. So I'm always shocked by it.
Well, think
it's
about
like their shtick.
But think about Japan. They actually don't want people.
You try and speak French, they're like, stop.
Yeah, yeah.
You try and speak Italian in Italy, and they're like, carry on, please. This is wonderful.
Really,
they sort of help you along.
Hold on a second. This got really personal, but you can actually speak some Italian. When I try, they're just like, I can speak English, please.
The French are just like, no,
yeah,
stop.
yeah. Well, it depends where you go in France.
Okay,
like Aix-en-Provence is like very friendly, and Parisians are kind of Parisians.
Yes, all right, there we go. Good summary. In case anyone wants to take advantage of the 107.55 on the screen right now. Investors keeping an eye on Wednesday's doubleheader. We'll get the latest inflation read with CPI coming at 8:30 Eastern Time ahead of a 2 p.m. Fed decision and Powell press conference 30 minutes later. Mike McKee's going to be a busy man this week. Michael, what are you focused on?
Where Lisa's going on vacation, I think. I mean, it's much more interesting.
Spin the 20-nation wheel. Take a guess.
There are 2 countries everyone's going to. Southern Italy is totally packed. That's what I hear.
Well, obviously, everybody's looking at Wednesday for CPI and then the Fed. The CPI number is going to sort of, as Ian Lingen of BMO put it this morning, set the trading tone for the summer because we won't get enough other data to really change people's minds over the rest of the summertime because we've got other events that will come in and affect people. So it's not going to be as much about the data. But we are going to get a kind of a weird CPI in the sense that the headline month over month is forecast to go down and the year over year headline is expected not to change, whereas in the core, the headline the core month over month doesn't change, but the year over year goes down. So if we get an as forecast number, what does it really mean? Does it tell us that there's enough progress? Which leads into the Fed and the idea that they held off last time because not sufficient progress had not been made, significant additional progress had not been made. Would that count as progress to see the core go down a tick to 3.4?
You used the W word, something that Peter Scher used too, weird. He said that a lot of this data has been weird. And I'm curious about why it's so weird. Do you subscribe to any of these ideas that this is messier data than usual because there just are fewer responses to surveys, that potentially there is something going on with respect to how difficult it is to quantify, or employees not being in place, or whatever other conspiracy theories people are coming up with that are leading to some of the really significant downward revisions later on?
All of the above. It's a combination of things. The data all got messed up by the pandemic in different ways because it changed consumers' buying habits, for one thing. The data then didn't fit, the historical data didn't fit a model going forward because people were behaving differently. We have seen response rates drop significantly, which makes it harder for the government statistical agencies to correct for that. The seasonals are all thrown off by what happened in the pandemic. So there's a lot of reasons why all this is happening. But what's interesting, when you get down to the bottom line of it all, Americans are still spending money. And that's kind of where the Fed is at. They're still getting jobs and they're still spending money. And we're not seeing huge changes in that. After the jobs report, the Atlanta Fed went up to 3.1% from 1.8. So
after being at 4.
We're still seeing stronger than expected growth. So the Fed has to make policy within that, and it just tells them they don't have to move if they're not certain.
I think it was 4, then down to 1, back up to 3.
I know.
That's like the last couple of weeks.
I know.
Isn't that just in the last 2 weeks?
Yeah,
yeah,
basically.
Amazing. Let's continue this conversation with Michael McKee. Joining us now is BlackRock's Amanda Lynham alongside Mark Zandi of Moody's Analytics. Let's set the stage like this. There's 2 surveys that go into the jobs report. Amanda, you know them well. 2 very, very different stories. What was Friday about?
Well, I think just taking a step back, as you noted, the overall establishment survey showed really strong momentum. Perhaps that might have been driven by some of the immigration that's coming into the country. The household survey showed a pretty meaningful decline, but that was really in folks that are under the age of 25. So it was really concentrated. And I think we've spoken about the bifurcation in the economy in sessions past. I think that's partly what you're seeing there. But in aggregate, as Mike noted, the economy is still chugging along, even if we expect some deceleration from, say, where the Atlanta Fed GDP now is, say we end the year at 2%. That's still trend or above trend growth. And I think for us, the shallow rate cutting cycle that we're expecting is really a product of that, because it's not obvious to us that there's urgency for the Fed to ease. We expect them to normalize, but not really to ease policy.
And Mark Zandi, 2 very different surveys. From your perspective, would you put more weight on one versus the other if you're sitting on that FOMC?
The establishment survey, the survey of businesses, I think that's the better measure. I mean, it shows the job market strong, resilient, creating lots of jobs. The job growth was very broad-based. But you can't dismiss the household survey and the increase in the unemployment rate. It does indicate that the labor market is really cooling off. If you look under the hood of the job market, hiring is weakening. We're seeing fewer quits. Unfilled positions are declining. Number of temp jobs are declining. Hours worked are declining. So, the job market's okay. It's fine. It's moving forward, but it's cooled off. It's, exactly where the Fed would want to see the labor market. Resilient, creating jobs, but, not at a point where it's fading inflationary pressures.
Dialing this weird aspect of the jobs report into what we're expecting in terms of CPI on Wednesday, Mark, are we measuring inflation correctly?
Well, yeah, we're measuring it, but there's all kinds of problems with it. I mean, if I were king for the day and at the Federal Reserve Board and looking at the inflation measures, I'd be focused on something that's called the harmonized inflation measure, or harmonized CPI, or harmonized PCE. That's everything except owner's equivalent rent. That's a mouthful, but OER is this implicit cost of owning your own home. That is very problematic. I've learned a lot about this, digging deep into it. It's very problematic even when things are going well, the housing market is well functioning. But as you know, the housing market's a mess. We've got a very severe shortage of affordable housing. We have a surfeit of high-end housing, and that's just scrambling things. So if you really want to get a sense of underlying inflation, my view is you use harmonized. By the way, that's what's used in the rest of the world. And if you do, it shows that, well, you know, mission accomplished. We're there. Inflation's back to the Fed's target, and it has been for quite some time.
Amanda, picking up on that point, I'm glad that Mark brought up the housing market. We heard this from Sarah Hunt also, that this is actually completely skewing a lot of the measures that we're looking at because the housing market's broken. And this is a key aspect of the U.S. economy and input into inflation. How much are you watching that and sort of using that as a gauge of credit strength more broadly?
Yeah, it's part of the reason why we like to look at the supercore, which is the services X housing. We're looking at a range of metrics when we're looking at the degree of restriction of monetary policy. I think from a pragmatic view, we're not expecting major changes to the Fed's inflation targets or the reaction function. I think they need to get to their target before they even think about kind of reevaluating whether or not these metrics make sense in this new cycle. But from a credit perspective, we're not seeing a massive degree of restriction across the credit landscape. We're seeing it in pockets, but we're not seeing it widespread. And so there are certain areas where, sure, borrowers would love to have some rate relief, but is 25 or 50 basis points going to move the needle for them? Probably not. And it's really the depth of that cutting cycle that really matters for risk appetite. But I think the good news is that most of these corporates are managing this backdrop in a resilient way. It's largely a function of growth, however. If we have a significant slowdown in growth and we have persistently elevated cost of capital, I think that's where we could become much more cautious.
Have the sources of finance shifted? We've talked a little bit about this over time. Does that make it more difficult for the Fed's policy to really get to maybe where it needs to go?
They have shifted in the sense that you've seen private credit play a bigger role, but even in the syndicated markets, we're seeing significant demand for leveraged loans, both from investors and for borrowers to issue there because the demand is so strong. CLO creation is high. There's a lot of technicals are really important in the credit market. But I think, yes, the sources of financing have kind of helped out a bit, but in general, the tone is just still very strong. And I think part of that is a function of corporates entered this period from a position of strength. But again, the growth has allowed corporate credit to absorb the higher cost of capital. I think it really hinges on growth. Even on Friday, the yield back up, we saw buying in IG credit, right? We saw investors coming into the market when we had a 15 basis point back up in yield. So it shows you the strength of that demand is really there. So it's hard to get incredibly negative on corporate credit spreads because even when it tries to sell off, you see either in spreads or in rates, the buying comes in.
Mark, it's really difficult to reconcile the conversation we have on Wall Street with the conversation you hear from FOMC officials around the issue of financial conditions. Can you tell us what is the difference between a Federal Reserve official saying financial conditions are tight and people on Wall Street still saying they're easy?
Well, I think they're right where they need to be. If you point to the equity market or the credit spreads, it feels like conditions are easy. But if you look at bank lending standards and the banking system in general, not so much. Credit is much tougher to come by. So the value of the dollar is strong. That's consistent with tight financial conditions. So if you add it all up and mix it up in a pot, feels like financial conditions are right where they need to be. So yeah, you can find things that show that they're easy, some things that show that they're tight, but all in, it feels like again the Fed's got financial conditions exactly where they want them.
At this point, though, Mark, how much is this boiling the frog? And this has been sort of one of the questions with the long and variable lags that, we're sort of doing damage under the hood that's suddenly going to come to the fore. And that was the belief earlier this year. It was a belief last year. And then people abandoned that and said, actually, things are just fine and we can live with rates right here. Do you have a sense of which it is, of where the balance of risks is in terms of holding conditions at this level for just a longer period of time?
Yeah, well, the most likely scenario is the Fed's going to pull this off, the economy is going to soft land, and they'll start cutting rates here pretty soon, and, things will settle in. But I do worry that they're holding on here too long, that's too high for too long. The labor market has signs of weakness. I went through a litany of those. The financial system is fragile, it feels to me. I mean, the yield curve is inverted. Short-term rates are still above long-term rates. That's not, consistent with a well-functioning financial system. That, it's a very uncomfortable position to be in for the system. So I've got this image in my mind of the system as an engine, and it's shaking tremendously under the stress of these higher rates. And so far, it's held together with little bit of duct tape and some help from the Federal Reserve and banking regulators, but for how long and why? Why would you do this? I mean, I think mission accomplished. I mean, full employment, 4% unemployment rate, inflation's back at target, properly measured, and has been for a long time. So why take the risk? So yeah, I do worry about that scenario. I don't think it's off the table, and I don't think we can take it off the table until the Fed starts lowering interest rates.
You wrote about it in the Washington Post. Note to Fed, it's okay to cut interest rates now. Sort of goes against, Mark, what we heard from Bill Dudley, who said the Fed thinks it's fighting inflation. Think again. How would you convince the Kashkaris of this world this week in a two-day meeting starting tomorrow? What would be the sort of cheat guide you'd say, you're wrong, this is the way I see the world?
Well, there's nothing that's going to convince anybody except data. So we get that CPI report. The consensus is that the core CPI comes in at 0.25, I think, to the second significant digit. And you need some 0.2s and 0.25s here over the next couple, 3 months. And I think then you'll make believers out of folks on the Fed that they can cut rates. By the way, 0.25, you annualize that, that's just about 3%, a little bit over 3. That's on the CPI. You make adjustments because the consumer expenditure deflator is constructed differently. You're pretty close. You're within spitting distance of target. And by the way, we're still, I get it. We're slavishly holding this 2% target on the PCE deflator. I understand the necessity to do that because of the credibility and everything else. But really, at the end of the day, I mean, is 2% the right number? I think most people would say no, it's probably higher than that. So why sacrifice the economy to the altar of a 2% inflation target if you don't need to?
We've heard a similar argument from Mohamed El-Erian over the last couple of months as well. Mark, great to catch up. Mark Zandi there of Moody's Analytics alongside BlackRock's Amanda Lynham. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A check on Southwest Airlines shares this morning, up nearly 8% in the pre-market. Elliott Investment Management has built an almost $2 billion stake in the company, that according to the Wall Street Journal. The size of the reported holding makes the activist firm one of the largest investors in the U.S. carrier, and that Elliott plans to engage with management. Tesla CEO Elon Musk's pay package is being put to the test at the company's annual meeting on Thursday. One of the company's largest shareholders, the Norway Sovereign Wealth Fund, said it will vote against the $56 billion deal. Norges Bank Investment Management says, quote, "We remain concerned about the total size of the award, the structure given performance triggers, dilution, and lack of mitigation of key person risk." NVIDIA's 10-to-1 stock split will take place today. Shares lower by about 0.7% this morning. The AI boom has powered the company to huge gains of more than 140% year to date. The share price surpassed $1,200 and the valuation passed $3 trillion. Goldman's David Kostin says that one of the key reasons for the split is to increase liquidity alongside retail activity. And that's your brief, John.
Danny, thank you. Appreciate this morning. Thank you very much. Up next on the program, Apple's AI vision.
They essentially have an AI-driven super cycle. Betting against Cook and Cupertino into an AI upgrade cycle, I personally believe is a bad bet.
Dan Ives there. Always one of the best, eh? You love that, Bramo. Makes you smile every time.
It's just so good. It's just he's consistently
Is it the
bullish.
vision?
It's just,
Sort of like the message, the style.
The style is great.
New York Post says he's the best dressed on Wall Street.
I saw that.
Yeah, I'm not sure what I think about that bit. Not sure what I think about that. From New York City this morning, good morning.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
We're probably going to spend this whole week talking about Wednesday, just Wednesday. We're going to do that Monday, Tuesday, Wednesday, Thursday, and probably on Friday as well. We are about 41 minutes away from the cash open. Let's check out the equity market first. Equity futures on the S&P 500 look a little something like this. We're negative by 0.1%. Yields are higher by 3 basis points on a 10-year, 446.50. Counting you down to that opening bell, here's your trading diary for the next 24 hours or so. Today, we will get a $58 billion auction of 3-year notes, plenty more debt supply to come through the week. We'll get Apple's World Developers Conference starting at 10 a.m. Eastern Time. And tomorrow, the Fed kicking off its 2-day meeting. I know Lisa's super focused on that debt issuance, 3-year, 10-year, and 30-year through the week.
Well, and it comes right after the New York Fed's 1-year inflation expectations today at 11 a.m. Just curious to see when people start pushing back. That's my big question, and I think the auctions really highlight that.
Pushing back because of what? The better data that's pushing yields higher, or because of the indigestion around how much supply is actually coming to market?
Well, I mean, it's basically indigestion around what price? It's essentially price-sensitive investors coming into the market after the price-insensitive investors, some of the central banks globally, on the margins are pulling back. So the bonds can clear. It's at what yield, at what price, and that's what we're looking for in terms of indigestion, how much the banks can take down, and what it costs to really clear it in the open market.
You know, a big takeaway from the last conversation we just had, we were talking to Amanda Liner from BlackRock and Mark Zandi from Moody's about the Fed decision on Wednesday, but big takeaway for me today is what she said about credit on Friday, that you had yields break out on Friday off the back of better than expected data, and people were buying corporate credit. The demand there was good. So what we're seeing basically is high yields on treasuries, but it's not crowding out what's happening elsewhere. And you can see that in the amount of supply we've had so far this year from corporate debt issuers and the amount of demand that's sort of met it over the last few months.
The amount of cash that's been created in this global economy is just overwhelming, and that's the reason why there are a lot of dollars looking for places in the higher yielding space. Right now, the U.S. is looking more and more like the higher yielding space as other central banks in the developed world cut. So at what point does this sort of infuse the debt market in the U.S. with a sense of confidence, because a lot of buyers are coming in from external places with lower yields now?
It's not all about debt. It's not all about the Federal Reserve or CPI on Wednesday morning. At the single name level, there's a big event this week, Apple's World Developers Conference starting at 10 a.m. Eastern Time. I'm pleased to say that joining us now is Bloomberg's Jackie Davalos. Jackie, walk us through this big event and what we can expect a little bit later on today.
It's a big day here in Cupertino, California, where the Worldwide Developers Conference is being held and starts in just a few hours, John. Now, remember, this is a developer conference. It usually gives the developer community a sense of what software and hardware is coming down the pipeline. But this year, it's all about artificial intelligence. That will be the central theme for Apple, which, as you know, has been a little bit slower to publicly state just exactly system will be called Apple Intelligence. This is going to kind of use the more generative AI that we haven't seen just yet. Apple is not a newcomer when it comes to AI. We have Siri, we have other apps that, you know, the health assistants that infuse AI into its systems, but generative AI is really what we're looking for here. Those features will be announced. And the other thing slated is a highly
OpenAI partnership, which will unveil a chatbot across AI systems. You know, they haven't announced their own chatbot to date. It's kind of been seen as a laggard in comparison to Microsoft and Google. So this is a big day and definitely one of the most high-stakes events for the company this year.
Jackie, Apple has a reputation of being late and being perfect and actually trying to nail something. This time, how much are they racing to catch up, being messy, and willing to break some things?
You know, it's definitely a risk. Apple has its own large language models, but it's looking to partners like OpenAI. It's also having discussions with Google's Gemini, as Mark Gurman reported, to be able to incorporate some of the already made products that are out on the market. Now, this comes with its own risks, but as we know, Apple's strength here really comes through in its devices. And so even if this isn't, you know, a big success, a lot of users will be using it. So it allows them to really iterate on what they learn from how people are interacting with this. The future, really, when it comes to artificial intelligence, depends on just how we interact through voice control, for example, allowing users to be able to control those without having to look at a screen full of apps. And this is really Apple's advantage because they do devices so well, Lisa.
Jackie, this was great. Looking forward to your coverage throughout today on Bloomberg TV and radio. Jackie Davalos there of Bloomberg in Cupertino, California. Apple, that stock is actually positive on the year now, year to date by a little more than 2%. And the carrot over that stock for the rest of the year, this year, is going to be September and that new iPhone. And how many of these features will be installed?
No, the big thing that's hanging over it is September. Will Jonathan Farrow go to an iPhone store, an Apple store, and actually purchase a new one because he's been holding off in order to get the latest iteration? You want to be the guinea pig?
Well, now I realize that the AirPod FaceTime issue isn't a personal, unique issue, that actually it's just a broader issue. They could just fix that, right? And then I won't need to upgrade.
Why not just use the plug-in?
I'm just not the audience. I'm the last guy to move.
It's true.
Like years down the line.
Yeah, well,
I'll never be that guy.
It's
I'm
the
just not the
kids.
forward-looking technological expert.
And the technological people who want to sort of explore the next thing and want to understand. You know, do you want to look at a blank screen and say, "Hey Siri, give me the number for this"?
Don't even use Siri.
You know. I know, but my phone's actually going.
Two types of people.
Right
Two
now.
types of people,
Yeah.
right? Headset people, the people that went and bought one, and the people that didn't. I'm like the guy that didn't. You know, and you didn't either.
Oh, hold on a second. Whoa,
You know,
pause.
two types
I don't
of
think
people.
that many people went and bought the headsets. It was kind of a limited product.
Sure.
But it's a pretty
But
narrow
they're the
slice
first
of
ones to
people.
walk
They're the
around
first
with this
adapters.
stuff,
But I
you
think
know,
that there's
use
a
it
broader
properly.
group of people who are the broader
Do you want an
adapters.
argument about this?
So, deeply. This has been what I've been waiting for all weekend.
I don't. The opening bell is just around the corner. 34 minutes away. Tomorrow's lineup: Ross Kostrick of BlackRock, Dan Ives of Wedbush, Omar Aguilar of Charles Schwab, and BNY Mellon's Alicia Levine. Is this about your vacation? That you're upset about?
Well, Julia.
Because
why
you're
are
not
we
in
going?
Italy. I know. We've got to sort that out.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zabe Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, "Look, I want you to be the face of the Washington Mystics." And I said, "What do you mean be the face of?" He says, "I want you to buy this team." His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City for our viewers worldwide, I'm Matt Miller. It is Fed week, and to kick it off, we have futures down across the board with S&P futures off 0.2%. The countdown to the open starts right now. Coming up, investors awaiting Wednesday's Fed decision and CPI print. Plus, the euro falls to its lowest in over a month amid European election fallout, and Apple preparing to unveil its AI strategy. We begin with the big issue, bracing for a big week.
CPI has been the biggest market mover for the better part of the last 2 years. It's not going to change on Wednesday. A big number either way. So something like a 0.2 or a 0.4, markets will go bonkers. Now, as far as the Fed commentary itself, that's the secondary event in our view. The Fed's not going to move Wednesday. That's no secret. Yeah, it might tweak the dots a little bit. Big deal. But the bigger story is CPI. Does it really change the chance in a meaningful way the Fed really could cut this year?
Joining us now to discuss is David Kelly, JP Morgan Asset Management Chief Global Strategist. David, great having you on the program. Let me first get your expectations for Wednesday. What are we going to hear from the Fed, especially after the strong jobs number that we got on Friday?
Well, I agree that the Fed's not going to do anything, so I'm not going to see any change in interest rates. I think the attention will be focused on the summary of economic projections. Have they changed their view of how the economy is proceeding? And then the dot plot. I think they will at least remove. In March, they had 3 rate cuts priced in. That's obviously not going to happen. The real question is, do they price in 2 or 1? But overall, I think their commentary is going to be, I think pretty comfortable. I think they feel like the economy is pretty much on track in terms of unemployment, in terms of growth. Inflation's a little high, but slowly coming down. So I think they're going to sound pretty comfortable about where we are, and I don't think there's anything really for markets to worry about there. I don't expect them to sound too hawkish or to give any indication that they're going to raise rates any higher. The inflation's cooling. It's just cooling slowly.
Were you surprised by the number of jobs that were added on Friday, as well as the increase to wages?
Well, a little bit, but I do want to emphasize that there's a lot of problems in the government data these days. If you look at the household survey, they say that the total number of workers in the last year rose by 376,000. If you look at the payroll survey, which is where, what people focus on, payroll job gain, they show that jobs increased by 2.7 million over the same period. One of those numbers is wrong. In fact, both of them are probably wrong. So I would take that with a large grain of salt. I look at the overall data on unemployment. There are a lot of different numbers. And sort of the mosaic suggests that the economy is very healthy. The labor market's very healthy, but it's not quite as strong as would be suggested by that headline payroll number or even that headline wage growth number.
All right, I want to talk more with you, David, about what investors should be doing. Right now, though, to get a preview of Wednesday's doubleheader, Michael McKee joins us, Bloomberg Chief Economics and Policy Correspondent. Michael, what should we expect?
Well, it's kind of interesting, Matt. We do have some other numbers this week. The NFIB small business optimism number is been cited by a lot of people, especially the jobs portion of that, in terms of how the economy is faring. And of course, we have PPI jobless claims later in the week. But the CPI is going to be the marquee item. And the issue there is the forecast. The forecast for CPI shows very little movement. Headline is expected to go down on a month-over-month basis, be unchanged year-over-year. Core, unchanged for month-over-month, go down a little bit. But is that enough to give the Fed any kind of confidence that they are making the further progress necessary that they have been talking about towards rate cuts? Obviously, we'll get an answer later that day because we get the Fed meeting. There'll be two things that people will be watching. One is the dot plot, of course. You talked about that. Will the Fed move the dots from 3? It would take one person to move to get to a 2-dot plot, but it would take 6 to get to a 1-dot plot. So 2 is more likely, but you can see what happened between the January and the March meetings. They went up. Do they keep going? And then what they call the terminal rate. Where are we going to see the Fed cut rates to? They moved up to 2.6 at the last meeting, but that's not anywhere near what the market and economists think the Fed funds neutral rate is. So do they change that? Because once they start cutting, that's going to have a lot of impact on what the trajectory for markets is going to be.
All right, Mike, thanks very much. Michael McKee is our Chief Economics and Policy Correspondent, talking about what to expect this week from the eco data. David Kelly is still with us, JP Morgan Asset Management Chief Global Strategist. And David, I want to talk about a great story that Bloomberg News reporter Lou Wang put out on the terminal this morning about a so-called bear market in diversification. You wrote that diversification is your best friend, or you said that diversification is your best friend on your worst day. The right asset allocation is a little bit like home insurance. You never know when you're going to need it, but you should never feel comfortable not having it. That said, as Lou pointed out, diversified or asset allocation funds tracked by Morningstar, 370, only one managed to beat the major stock index, the S&P 500. In fact, out of the last 15 years, there have only been 13 years when diversified portfolios have outperformed the S&P 500 because of that concentration in the mega cap growth stocks. How do you make sense of this?
Well, I think it's very important to recognize that it's not just that we've got concentration. That concentration is getting more and more intense. So the top 10 stocks in the S&P 500, of 500 stocks, the top 10 account for about 35% of market cap right now. The United States accounts for about 64% of global stock market capitalization. So there's a huge amount of concentration in mega cap names in the United States. There's a huge amount of concentration in US stocks. And the problem is that when you've got this calm, soft landing economy is just chugging along, what's happening is people are doubling down on what's done well recently, and that's causing more and more concentration risk. And the thing about diversification is of course, there's always going to be a strategy that did better than that, but sooner or later you're going to have a shock, and when you have a shock, those things that are overpriced are most vulnerable. So I would urge people, every year they print your returns. They don't print the risk you took to get the returns, but people are taking more and more risk if they're heavily concentrated in large cap US equities. So that means international equities, it means small cap. It also means alternatives. We put together a guide to alternatives, just looking at all the sectors of alternatives, and really given the opportunity set in public markets, but also the risk in public markets, it makes sense to diversify not just within public markets, but also within private markets.
Jess Menton on our stocks team also wrote a great story on the terminal pointing out that, the mega cap growth stocks have provided, as we know, all of the earnings performance, but there's a broadening out that's expected. And indeed, the mega cap growth stocks should not see the kind of earnings growth that they have going forward this year. Do you expect that broadening out to materialize so that we see, energy, materials, industrials start to come up and support the performance that we've seen from the big internet companies?
Absolutely. I mean, we're looking very closely at what these companies are doing, but also analyst forecasts for all the sectors in the S&P 500, and we do see that broadening out. And the question is, at what point does this broadening out in the earnings performance get mirrored in a broadening out in market performance. If it doesn't, you end up with even more concentration risk. So I think it's very important for people to be diversified. Sooner or later we're going to have a shock. We don't see what that shock is right now. Sooner or later it'll happen. And with that broadening out in earnings performance, I think it makes it even more urgent that people broaden out their exposure in markets.
David, I want to ask you as well about the election results that we've seen in Europe over the weekend. Big losses for the center-left parties or center-right parties, the middle, especially in France, in Germany, in terms of the European elections. You wrote about election risk in your most recent note, more focused on the U.S., though, saying significant policy changes with regard to taxes, immigration, and trade are possible. Does this highlight that risk? Does this increase that risk for us in November?
I don't think so. I mean, it's interesting that Emmanuel Macron, the French president, decided to call snap elections. I personally think he overreacted. I think he's going to leave himself in a worse parliamentary position than he had before. And I don't think he should have done that as a politician. But in general, if you actually look at the numbers in Europe, yes, there have been gains by the far right. I think there's a lot of dissatisfaction in terms of immigration in Europe. But overall, the centre did hold, and most of the European Parliament is going to be, most of the seats go to centrist parties. I don't expect big policy switches in Europe. So overall, I think European democracy is pretty healthy here, and I wouldn't overreact to these results that we've been getting over the last day or so.
Are there industry groups, though, that would rise or fall depending on, if we see a change in the White House here, if we see a change in Senate leadership here? Are there certain bets that you think investors should make, or, problems they should be prepared for?
Well, I think one of the things we need to look at is tax policy. I think that obviously could affect the relative valuation of U.S. versus international stocks if we ended up with higher U.S. corporate taxes. But also look at tariffs. I mean, if we get into a tariff war, that's going to slow the whole global economy down, and ultimately that's not good for the United States. So I think. There is political risk. We generally tell people don't let how you feel about politics over what I think about investing. But if you think there's big political risk in the United States on both sides, then should you be zero weighted on international equities? Because a lot of people are. And I do think that diversifying around the world is just as much a part of diversification as diversifying out of the Mag 7.
Looking more specifically here in the U.S. at the consumer, David, consumer discretionary stocks have underperformed. Real estate has really underperformed, even though things like, for example, car sales, I noticed, continue to rise. What do you think about the U.S. consumer here in the U.S. and those groups that have underperformed the rally in the broader S&P?
Yeah, there is a squeeze at the lower middle income level in consumers. And the way you can see this, we always see this, is if you look at real spending on food at home and real spending on clothing, those begin to drift down. And if you look at consumer non-durables altogether, so that's food and clothing and other short-term items, that was lower in April than it was in December. And that tells me that there is a squeeze going on lower middle incomes. Higher income individuals are doing okay, but because of higher rent, because of higher insurance costs, I think lower middle income households are being squeezed, and that is a problem for some companies that are selling stuff to the masses. I think people who are selling luxury items, luxury services should do well, but there is a macroeconomic headwind for those selling goods and services to the masses.
David, thanks so much for joining us. Great to get some of your time today. David Kelly is the Chief Global Strategist at JP Morgan Asset Management. Now let's get a look at what the stocks moving ahead of the opening bell. For that, we go over to Abigail Doolittle. Abby?
Matt, the futures may be down slightly, but we have a number of notable stocks that are higher, starting off with the shares of Southwest Airlines, up about 7%. This, as Elliott has outlined, that it's taken a $1.9 billion position in the stock. Lots of headlines breaking. They are saying they want to bring on new leadership, and a headline breaking just a moment ago, they are going to target the Southwest CEO and chair, really trying to bring value. A real headline or eye-catching headline is the idea that they think that they can unlock the value of this stock to $49. That would represent more than 75% upside potential if they can achieve that. Turning to CrowdStrike, this stock, along with KKR and GoDaddy, all higher on the news that on the rebalancing that will occur on June 24th, these stocks will be added to the S&P 500. That means managers, index managers, will have to buy these stocks so that their portfolios match the S&P 500. And then finally, Apple up ever so slightly, Matt, this, of course, ahead of their Worldwide Developers Conference that kicks off later today. AI, not surprisingly, expected to be a big focus.
All right, Abigail, thanks very much. Abby, you're going to stick with us throughout the program. Coming up, far-right parties gaining ground in Europe.
There remains a majority in the center for strong Europe. And that is crucial for stability. But it is also true that the extremes on the left and on the right have gained support.
That conversation still ahead with Tina Fordham, Fordham Global Foresight founder and geopolitical strategist. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
There remains a majority in the center for strong Europe. And that is crucial for stability. But it is also true that the extremes on the left and on the right have gained support. And this is why the result comes with great responsibility for the parties in the center.
The euro slides to its lowest against the dollar in over a month after a surge of far-right victories in the European parliamentary elections and maybe more importantly, huge losses for the center-right and center-left leaders. French President Emmanuel Macron called for snap elections. In Germany, Chancellor Olaf Scholz's Social Democrats got their worst ever result behind the far-right Alternative for Deutschland. Joining us now is Tina Fordham, Fordham Global Foresight founder and geopolitical strategist. She's also the first ever chief global political strategist, global political analyst on Wall Street for Citi, of course, advisor to UK Prime Ministers, speaker at the UNGA. Tina, great to get some time with you this morning. What do you make of that result? What drove the big losses, really, for the center?
So first of all, I've got to push back on your characterization of the result. It's really important to understand that the center has absolutely held in the European parliamentary elections. The polls actually, in contrast to the recent elections that have given us a surprise elsewhere in the last few days, the polls were broadly on target. The center block of European, the European parties has held. What has happened is that France is hit hardest by a surge in the populist right. and Macron has called a new election, but we really shouldn't overinterpret the results to say that Europe has been taken over by the far right. This is just not accurate.
Well, but certainly by the right, Tina, because the SPD, which you could consider center-left, although from the U.S. perspective is way left, right, got a worse result than the AFD. And in fact, the CDU-CSU got double what the SPD did. So if the CDU-CSU would cooperate with the AFD, it doesn't look good, and so they won't do it. The right would have almost 50% of the German vote. In France, the National Front got more than twice what Macron's party got. So certainly something is...
These aren't national elections. People vote differently in European parliamentary elections than they do in national elections, which is why Macron's move to call a snap election, this is legislative, by the way, it's not presidential, is really important. It is a big gamble. But Europe is not moving to the far right wholesale. In fact, in many countries, I'll give you some examples, in the Netherlands, in Poland, and in Sweden, for example, far right parties actually got a bit of a drubbing. So what we don't really have is a uniform trend across the 27 countries of the European Union.
How dangerous is Macron's call for snap elections? Because you've advised UK governments who have made, for example, David Cameron made a move like this, which resulted in Brexit, right? A lot of people are calling Rishi Sunak's recent call for elections July 4th a huge mistake. Does this make it look like Macron doesn't have any cards left to play?
On the contrary, or au contraire, I think that Macron's move is very gutsy. It's got everybody I know in France, French investors on the edge of their seat. But what he has done actually has a lot of logic. He's hoping to, to really cut the legs out from under the national right and to call the bluff of the French people and say, okay, we heard you. You've cast a protest vote. Do you really want these guys making policy in the country, or did you just want to send a message? Because let's think about what France looks like under a far-right government.
So you think that this is the right all-in bet because he has a full house, for example? I mean, if he gets it wrong, does Marine Le Pen take over?
No, he has to serve in cohabitation together with Le Pen's party. And there's another little wrinkle here, which is that Marine Le Pen rather cleverly has put a rather charismatic and, I can say this, handsome 28-year-old fellow in charge of the party, and he has appealed to young French voters and the TikTok generation, which is an undercurrent to voting that I don't think investors tend to focus on. Will that translate into big gains? And remember, we also have 2 rounds of voting, so it's very difficult to try to compare this to the U.S. system. And I know it's maybe seems like too much detail, but it's important not to conflate this with the UK elections either. They have the 2-round system can sort of allow people to cast a protest vote in the first round and kind of come to their senses in the second round.
It's key to get that kind of detail, and that's why we have you on, Tina. And also because, obviously we're 10 minutes away from the opening bell. We're not really a political show. We're focused on the stock market, and you were indeed the first chief global political analyst for any Wall Street bank. How do you talk to clients about the fallout this is going to have in markets?
Well, we've got to go through the probabilities and the scenarios, but I think that there is a lot more nuance than meets the eye. They're not binary outcomes. We are looking at a very crowded early July, which is unusual. If there is a big kind of macro existential question, it is whether people will elect governments that markets won't hate anymore in a more complex environment. But when it comes to wider contagion risk and, coming back to the case for EU equities and for the euro, I actually think that this reaction that we saw at the European Open is going to settle down, and that the political risk premium is going to be limited to France and probably just to a couple of sectors like financials.
All right, really great to get some time with you, especially on such short notice. Tina, thanks so much. Tina Fordham is Fordham Global Foresight founder and geopolitical strategist. Coming up, we're going to speak with Seema Shah of Principal Asset Management at the opening bell. This is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
We are looking at futures pointing down ahead of the opening bell. Let's get some of your morning calls this morning and look at some of the analyst recommendations on Wall Street. First up, Morgan Stanley is cutting AMD to an equal weight and a hold equivalent. The firm says investor expectations for the chip maker's AI business seem too high. Next up, JP Morgan is upgrading Walmart to an overweight, saying the stock adds a strong balance of defense and offense ahead of an uncertain second half this year. All eyes, obviously, on the consumer. And then finally, Jefferies upgrading Planet Fitness to a buy. The firm sees a clearer path towards growth for the gym operator. Coming up, we're going to speak with Seema Shah. She is Chief Global Strategist over at Principal Asset Management. We're going to ask her why the U.S. economy stands out, continues to stand out from the crowd. Is it still the only game in town? This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is the countdown to the open. I'm Matt Miller. We are moments away from the starting bell. Futures pointing down across the board. European stocks down as well after the surprise election results, or maybe not a surprise. Tina Fordham says they were in line with the polls. There's the opening bell ringing on the New York Stock Exchange and on the NASDAQ. We are looking at some other asset classes as well that for the first time really have changed. Since I've been back from paternity leave, almost a month now, the euro has traded at $1.08 and change every single day at this time. Now we're down in a new handle at 107.40 after those European elections over the weekend. The 10-year yield at 4.45, NYMEX crude at 76.02. One of the stocks we're watching at the open is NVIDIA. It's become the fourth Mag 7 stock to split since 2022, showing enthusiasm for the potential of AI and trying, I guess, to draw in more retail investors. Abigail Doolittle has more on this split. Abby?
And shares hanging in there. Right now, the stock down just modestly. Earlier in the pre-open, down about 0.4%. In the pre-market, I should say, it had been down closer to, let's call it 1% or more. And as we all know, this doesn't mean anything different for the value of the stock, but it has a much different number. Folks who don't know about this split, they may sort of panic when they see that the stock's at 120 instead of $1,200 on that 10-for-1 split. The last time, I think you just mentioned this, that it traded at 120 not so long ago, because this stock's move into that $3 trillion market cap has been so parabolic. That was just October of 2022. As for analysts, they're still positive on this story in AI. And for one example of what one analyst is doing relative to the numbers, TD Cowen is bringing up their price target to $140 from $120, and the long-term model demonstrates an ability for NVIDIA to generate nearly $6 in split, that's split adjusted, so that's actually $60 in earnings per share. That's really pretty incredible, Matt. Right now, the stock down closer to those pre-market levels, but NVIDIA, in its greater than 2,000% rally over the last 5 years or so, not really being stopped all that much today, just a small decline.
Yeah, absolutely. Monster of a stock, $2.945 trillion worth of market cap. Abby, thanks very much for that. Sticking with market milestones, CrowdStrike now joining the S&P 500 in the latest quarterly weighting change. Simone Foxman is here with more on that. Simone?
Yeah, Matt, CrowdStrike shares are rallying pretty sharply this morning, up 7.3%, as capping year-to-date gains of about 47%. This on that latest S&P 500 rebalancing. rebalancing. CrowdStrike, KKR, GoDaddy are all in, while Robert Half, Comerica, and Illumina are out. This is driving a lot of the trading in the market that we're seeing this morning, with KKR shares also up 7%. GoDaddy feeling this a little bit less excitingly. CrowdStrike and GoDaddy here really capping a run, a push into software and cloud computing companies, AI companies that we have seen by investors in the market. Notably, one company missing out, Palantir, has not been included in the S&P 500 index, even though Wedbush analyst Dan Ives says he thinks that we'll get that by the end of 2024. All these changes will take effect by June 24th. Of course, S&P 500 rebalancing so important given just the importance of passive index funds in moving money across the world, Matt.
All right, Simone, thanks very much. Simone Foxman there on reweighting. I want to give you some breaking news on Facebook. The owner of the website Meta getting a Supreme Court review on investor data harvesting. The U.S. Supreme Court has agreed to consider killing a multi-billion-dollar shareholder lawsuit that accuses Meta Platforms of misleading investors about the data harvesting scandal involving, you may remember this, Cambridge Analytica. So an interesting Supreme Court case coming up to watch. Let's turn to airlines now. Elliott is calling for new leadership at Southwest Airlines. Earlier, it revealed an almost $2 billion stake in the U.S. budget carrier. Bloomberg senior aviation reporter Sid Phillip has more on this. So, Sid, a massive stake. It's only a $16 billion company, so they have an eighth of it now.
Yeah, so Elliott's taken a massive stake in Southwest Airlines, and they sort of hit the ground running hard because they've asked for management change, including asking for management from outside. They've asked for change in the board, and they've also asked for a business review of the company. And so it's going to be interesting to see how Southwest Airlines responds to these requests by Elliott, and also how they sort of fend off possible changes to both its CEO and the chairman, as has been requested by Elliott.
So is this, I mean, it's interesting that Elliott gets involved in an airline. It seems unusual for them. Do you see other activist investors getting involved in airlines, Sid?
We've already seen Carl Icahn taking a position in JetBlue. And so there is, especially among the smaller carriers, there is some sort of concern that there may be more activists taking, especially since airlines have underperformed the sort of broader market in the run-up since the pandemic, and as demand has come soaring back. So it will be interesting to see how the other investors respond to it.
You are, Sid, the master of airline coverage. I always go to you when I need to know anything about airlines globally. This market is very different, right? The U.S. market from the European market in which you live. What can be done to wring out more profits from U.S. airlines?
So the U.S. carriers have been talking about sort of how there is sort of this demand at the top end of the market. They've seen lots of premium demand, but at the bottom end of the market, there's been some sort of pressure among the ULCCs. And that's sort of very different from the European position, where you have the likes of Ryanair, EasyJet, and others who basically dominate the market. And we also sort of seen the Lufthansas and the IAGs that all sort of look at the long-haul sector. So in the US, it's slightly different. We've got the ULCCs under pressure, and it will be interesting to see how they respond to those challenges as they go forward.
All right, Sid, thanks very much. Sid Phillip there covers airlines for us globally at Bloomberg News out of London. Now, Seema Shah, Chief Global Strategist at Principal Asset Management, weighing in on the growth of the U.S. economy, writes, although many other economies are seeing a cyclical upturn, the U.S. will remain the strongest global performer. Seema joins us now to talk about investing in U.S. stocks. And Seema, I mean, you can't go wrong, right, just buying the S&P and sitting still. Lou Wang wrote a story this morning pointing out that diversified asset allocation funds have underperformed the S&P in 369 out of 370 cases. Is there any argument to diversify now?
Hi, Matt. Yes. So look, the US, we do believe, is going to continue to be a very strong performer. It's backed up by its huge exposure to AI and tech. So that really is going to continue to drive the US. But I do think increasingly there is a case to be made for divergence, not just within the US and kind of outside of just the tech stocks, but to value to other sectors, but also internationally. You know, the US economy is very, very strong. But as I said in that note, you are seeing the cyclical upturn arrive in other parts of the world. And it doesn't mean that their economies are going to rival that of the US. But I think when you're looking at valuations and how attractive they are in other places of the world, if you compare the European market, the UK market to the US, there are some really interesting opportunities, which now the fundamentals are also starting to support.
Does the European election, or do the European election results that we saw over the weekend give you pause in terms of investing there? I mean, they were pretty jaw-dropping, but Tina Fordham pointed out to us earlier that these are not the same as, national elections, even the snap election that'll be held in France.
Well, Tina's absolutely right. They were jaw-dropping headlines, and I can understand why there is concern spreading through the market around it. But they were very, very much in line with expectations. You are continuing to see a bit of a rise in the right, but actually the centrist parties have continued to do well. So actually for us, it doesn't change the outlook for European stocks, but it does remind us that, look, we came into this year knowing that this would be the year of elections. So many elections around the world. We have this continued focus, of course, on the US, but so many different parts of the world where there can be upsets, as you've seen in the last week with India and Mexico as well. So I think it's a good reminder that that political risk probably does need to be priced back into the market to some extent.
In terms of cuts from the Fed, a lot of investors, pinning their hopes on this, even as, well, for example, the ECB cut rates and raised its inflation forecasts, right? Is the Fed in a good position to cut rates when we still see, even core PCE? I think the expectation is now 2.6% for year end, and it could be raised tomorrow or Wednesday.
Well, I think for the ECB, it was a considerably more clear-cut case for them to cut rates last week. They did, as you said, they did raise their inflation prediction, and they have had a couple of prints which have been stickier than expected. But actually, if you look at the overall decline from that incredible peak of 10.6 down to the sub 3% level, they had a very, very strong case, although, of course, from here, there's a slightly more cautious path. I think for the Fed, it's a little bit more unclear. You have had a number of prints which are very, 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 very strong inflation numbers. But on top of that, there just doesn't seem like there's a clear need for the economy to get that kind of easing. So although we are expecting rate cuts in September and December, I don't have particularly strong conviction on that. I am going to be waiting, just like the Fed is, for how the data unfolds. And I think that if you do get a very strong CPI number on Wednesday, well, then all bets are off, and we're really looking at the end of the year, if not 2025.
I was talking about a story by Jaron Wittenstein and Jess Menton earlier that points out all of the gains, as we know, have come from big tech, right? But in earnings as well, it's really been the big tech companies that are powering the 3 quarters of growth that we've seen. That's expected to die off, and we really need to see a broadening out. You need to see better earnings at industrials, at energy producers, at materials companies. Do you expect to see that throughout the rest of the year? And should we be broadening our bets as investors as well?
So I think you've actually raised probably the key question that just come up throughout this year, where investors look back at 2023 and they're like, well, the only really bet that mattered last year was whether or not you're invested in the Mag 7. Is that going to be the case for this year? Now, as we said before, there's a huge amount of concentration. Earnings growth in tech has been the strongest. But actually, what you have seen in the latest earnings season is that there has been a broadening out. So you are seeing positive growth, earnings growth, in a number of other sectors. Energy is probably one of the few that hasn't. Now, as that continues, and provided that the economy finds downshifting, but as long as it stays fairly solid and consumers, maybe a couple of strains here and there, but not spreading throughout the market, then actually, yes, you should see other sectors joining in. And just like the argument with international diversification, where valuations are more attractive elsewhere, other parts of the market in the US are showing more attractive valuations. There's a bit of a catch-up trade to be done. So provided no recession, then I do think that investors should maintain exposure to some of those mega cap tech stocks, but also start adding exposure to the other sectors. Parts of the market haven't been as loved up till now.
Seema, the tech stocks are up 22% year to date. The S&P is up 12%. Consumer discretionary is only up 2%. So really underperforming, as I guess investors are worried about the U.S. consumer, but we saw a blowout jobs number and increased wage growth on Friday. Does that give you more confidence in the consumer?
Well, I think it's interesting with a consumer because you are seeing there's a really significant divergence. Actually, sorry, not too significant. There is a divergence going on. So what I mean by that is the lower income consumers are showing some strains, and you can see that coming out in the credit card data in a couple of the underlying surveys. And it makes sense because consumers are the ones which are going to be lower end consumers are the ones that are going to be most exposed to the higher rates and higher inflation, sticky inflation environment. But the thing is that with the US economy, as long as your high income and mid income consumers are fairly solid, they still have the strong balance sheets, that can really carry the US economy over the line. So you're seeing strains, but provided it doesn't spread, and for it not to spread, you have to have a solid labor market. So at the moment, the data is really supportive of a continued robust economic environment, albeit it's downshifting, but it's still solid.
All right, Seema, great to get some time with you. Thanks so much for joining us. Seema Shah there, Chief Global Strategist at Principal Asset Management. Coming up, Apple's moment of truth.
Apple is missing is AI capabilities, and that is something some of these China vendors are starting to show. China also has a leg up in the sense that they are releasing more and more foldable phones out there which the consumer likes. That's something Apple does not yet have in its pipeline.
We're live at Apple's Worldwide Developers Conference next. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Apple is missing is AI capabilities, and that is something some of these China vendors are starting to show. China also has a leg up in the sense that they are releasing more and more foldable phones out there with the consumer likes. That's something Apple does not yet have in its pipeline as well. So if they can kind of answer some of the questions on the AI side of things, showcase some new capabilities out there for the consumer, I think that helps the China story as well.
Apple's $471 billion rally facing its next big test today, the company's annual Worldwide Developers Conference, promising to showcase long-awaited plans for AI features across its native apps. Jackie Davalos, Bloomberg tech reporter, joins us now from Cupertino. So, Jackie, how far do we expect Apple to go? Because I'm sure they have the capability to launch a lot right now, but it seems like a lot of big tech companies are holding back, just kind of waiting to see how consumers interact with these tools.
Expectations are extremely high today when you think about just how mum the company has been about its plans in artificial intelligence. It's certainly like a laggard when you compare it to tech giants like Microsoft and Google. But today, there's no surprise that the central theme will be artificial intelligence and how the company plans to integrate this technology across some of its most ubiquitous products. Now, thanks to our very own Mark Gurman's reporting, we do know some things coming down the pipe. Among those, its new AI system will be called Apple Intelligence. That will be in the form of its new operating system for its iPhone, its iPad, and its Mac OSs. Now, here is where we'll get a slate of features, whether it's transcription services, custom emojis, and other generative AI features that we just haven't seen yet across Apple's products. We'll also hear about a new partnership with OpenAI. Now, this is very important given Apple does not have a chatbot of its own, so it's tapping the ChatGPT maker for a similar technology that will go inside its products.
You know, I actually ask Jackie, I ask Siri a lot of questions, and she never fails to disappoint. Then I have to move on to Google or ChatGPT to actually get answers. Will they be using this partnership to enable Siri to be useful?
That's certainly the hope here because, as you said, Siri is somewhat of a disappointment. It's kind of the main large language model application that Apple has had to date. But going forward, you're absolutely right, Matt, that the devices and the way humans are interacting with them through voice, through this conversational manner, will be exactly how Apple gets a leg ahead and shows that it's actually in the game. Devices are what it does best. And so today, absolutely, we'll get an update in terms of how Siri is being revamped and just the other types of devices that might interact with it. Think AirPods, perhaps even robotics, and just other types of devices and products that Apple already has in its slate that humans will be able to interact with in just a very different way.
All right, Jackie, thanks very much. We'll be coming back to you throughout the day for more coverage of the Worldwide Developers Conference. Bloomberg's Jackie Davalos there. Now, for some sector price action this morning, let's get back over to Bloomberg's Abigail Doolittle. Abby?
So overall, we are looking at a small decline for the S&P 500, down about 0.3%. Not surprisingly, most sectors are lower. It's a broad-based small decline. Financials the worst. Not a huge decline, though, down about 0.6%. Tech down about the same amount, down about 0.5%. Communication services down 0.4%. To the upside, we do have utilities trading higher by about 0.8%. This, of course, is interesting given the fact that yields are higher. Typically, when yields are higher, those dividends would look less attractive. But this year's big play, as you know, Matt, on utilities is around the idea of AI usage in the future. As for clean energy, not doing so well over the last 3 days, down more than 3%, the worst 3 days in about 6 weeks. It's not entirely clear what's behind this, although I do see that SunPower's short interest has increased, so maybe a little bit bigger of a bearish bet there weighing on sentiment.
All right, maybe a launch pad for a rally. Abigail, thanks very much. Abigail Doolittle looking at some of the sector action. Coming up, we're going to look ahead to the closing bell with Bloomberg The Close co-anchor Romaine Bostick on a new look. This is Bloomberg.
Headlines covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg's The Close relaunches this afternoon. Big focus will be Apple's Developers Conference. Obviously, co-anchor Romain Bostick joins us now. Romain, there's a lot going on beyond that in tech, right? It's a huge day. NVIDIA split, for example.
Yeah, the NVIDIA stock split. You already see the volatility in that stock this morning. The Apple Worldwide Developers Conference later today. And it's really just a reminder of just the dominance of big tech. You know this better than anyone here. What are we talking about? The representation of tech right now in the S&P. It's more than 30%. And what's the next biggest sector? It's like financials, and that's like 12%. So as big tech goes, so goes the broader market.
Yeah, and they've all underperformed. All the others have underperformed, right? I think big tech is up 22%. Yeah. The S&P is up 12%, and everything else has done worse.
Yeah, why would you be in anything else? I mean, I know why you're supposed to be in anything else, because I'm told we're all supposed to be well diversified across all asset classes. But look, I mean, look, if you are an active manager, you have to chase returns, and the returns right now, at least for the last, I don't know, 6 to 12 months, it's been NVIDIA, Microsoft, Apple, Alphabet, Amazon, et cetera.
All right, so tell me about the relaunch of The Close. I've seen the amazing new graphics package.
We got a couple of fantastic
co-anchors.
We got this new set here. You know how hard I worked on this set? You know, it was a lot of trouble. Every weekend I would just come in, roll up my sleeves, put all this down. So it's going to be a new look, a fresh look, got some fresh faces and everything, and a lot of fresh new voices here. We're going to talk to Steve Wozniak a little bit later about the Worldwide Developers Conference. Sam Palmisano, remember him? He used to run IBM. He's huge into AI. We're going to get his insights as well. And the Bond King. And he still says he's the king.
Bill Gross?
Yeah, he's stopping by the program too.
Awesome. And we're not going to lose the simulcast. You're still going to have the simulcast.
That's your favorite part of the show, I'm sure, isn't it? Yeah.
I like it a lot.
Yeah.
It's very popular. It's done very well.
It's very popular, and it really gets home to this idea too of just how important really the final hour. And let's be clear, the two most important hours of the trading day are where you're sitting right now here at the open from roughly 9:30 to about 10:30, and then from 3 to 4. Biggest volume jumps that we see during the day are in those 2 hours, with the biggest jump coming in the final 15 minutes of trading.
All right, well, I watch it every day, and viewers can tune into a new look today. Romain Bostick, co-anchor of The Close. Be sure to tune in to Bloomberg The Close weekdays at 3 p.m. Eastern Time. Now, we are seeing slight losses on the S&P 500 right now, slight losses on the indexes with no gains. The Dow, really little change, but who watches the Dow Jones Industrial Average these days? This was Countdown to the Open. I'm Matt Miller. This
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Great World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. Alex Steele, Paul Sweeney. We are bringing Bloomberg Intelligence your way for the next couple of hours. Big day out in Cupertino, California, Apple, with our developer conference out there later today. Big on the AI front. So we're going to break that down with Jackie Davalos, Bloomberg Tech reporter. She's in Cupertino, and Anurag Rana, Bloomberg Intelligence Technology analyst, will be coming up as well in this half hour. Carol Pepper, founder and CEO of Pepper International, will get her market call. And David Powell, senior Euro area economist for Bloomberg Economics, on the EU election results and the impact on the European economies. Big news coming out of the EU and France calling for those snap elections there. So a lot going on the geopolitical front as well. We'll get to all of that. But first, let's hop over to Lisa Mateo and get a Bloomberg business questions.
You got it. Market Drivers brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest at ibkr.com/RIA. All right, to the markets we go. Well, there's a little movement right now. Traders kind of bracing for this double dose of volatility on Wednesday. The latest read on consumer prices. Also a rate decision from the Fed. Now, the options market betting that a 1.25% move from the S&P 500 in either direction, depending on what happens with the Fed. So right now we have the S&P 500 down about 0.1% or 9 points at 5,337. The Dow, little change, up 28 points at 38,826, and the Nasdaq down 0.3% or 53 points at 17,080. We'll take you to the bond market. We have the 2-year yield at 4.88%. That's little change. The yield on the 10-year 4.46%, and that's up 2 basis points. To currencies, the euro slid to a 1-month low. The far right gains in the EU vote right now. The euro down about 0.5% at 107.37 against the dollar. We have the dollar is stronger. Aside from inflation data, Fed decision, you talked about it, all eyes on Apple's Worldwide Developers Conference. Today, the company expected to lay out that vision for artificial intelligence. We have Apple shares down nearly 1%. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa Mateo. I'm Alex Steele alongside Paul Sweeney. Happy Monday. I know it's hour
Exactly.
12 for you, but
Sure,
you know, it's
we're
happy
on it.
Monday for me.
Yeah, back in the saddle, it's all good. We've had some European news come out on the political
was pretty
front. Yeah, so we
interesting,
were all
yeah.
over that for Bloomberg surveillance. But of course, I think one of the big issues today is just kind of Apple and what they can say out there at their developers conference about AI. I know
Yeah.
a lot of folks are going to be paying attention to that.
What's also interesting is NVIDIA stock split starting to trade today,
Connection lost.
but the stock is down 2%, which is so unusual. Goldman Sachs basically says that usually when you have stock splits around 2019, the share price typically rises by 4% in the week after the announcement. So
Yeah, exactly.
that's interesting.
I would have thought you had just more retail investors
Totally.
can come in, but there's not. You can buy partial shares these days, so that
that's
makes it
interesting.
less of an issue than it used to be. But still, though, stock's sitting at $118 a share. But here's a 2.92 trillion market cap.
Yeah, I mean, it's still kind of big.
Yep.
Let's go to Vince Signorella, a Bloomberg macro strategist. He joins us now. What are your thoughts on NVIDIA down by 2% after the split?
No, I think you made a really, really good point because I'm a little bit surprised it didn't trade the way some other big name stocks traded after a split, like Meta, Amazon, et cetera, or Tesla, and even Apple. It's like after they split, the stock seemed to go right back to where it was prior to the split and just surge. I don't know if that's yet to come. Maybe there's just a little anxiety with CPI, the FOMC on Wednesday, and then more inflation numbers to come on Thursday. But, overall markets a bit mixed, but a little bit lower. But if the predictions of to what Apple is supposed to be come true in the next couple of years, you would expect to see that stock continue to outperform.
Hey, Vince, just from, I know you don't really focus on individual stocks too much, but when you see like GameStops and these meme stocks in the marketplace, I mean, whether it's this year or back in 2021, what does that tell you about the market? Do you take any market moving issues with that, or is it just kind of people being nuts?
I think it's the latter.
You knew he was going to say that.
Yeah, well, I think you've seen what, realistically, it's like the retail investor has forever thought the big guys run the roost and that they can't compete and the market's rigged and retail gets run over. And for the opportunity to retail to take a pound of flesh back, I respect that, and I kind of think they're just having fun with it, and they're basically just trying to beat the big guys at their own game for a change. It'll be interesting to see how this plays out. Andrew Left is back shorting it again, although he says it's not a big position, but it's not performing the way it was in 2021, and I think that's because partly folks don't have the liquidity or the extra cash maybe they had during the pandemic, and partly you saw where that stock went and then how it just came back down to earth.
Yeah.
And so I think retail investors also realize the danger of playing in that game. Day trading is a really, really, really tough thing to do. It's definitely not recommended for the faint of heart.
This is definitely why I don't do that. Before we let you go, Apple's down 1%. It has had a monster run up since the end of April. How are traders talking about WWDC today?
The most folks that I talked to were a little bit surprised for the rally in Apple, to be honest. The feeling is that they've kind of missed the AI boat. Obviously have a huge balance sheet. They could correct that if they want to go out and buy something to put that all together, but it looks like they want to grow it in-house. And so far, they just haven't been able to do it, and they've kind of missed it. And, if you think about what Apple has or what Apple is going to produce, as your commentary a short time ago with Paul and Tom and our reporter, no new hardware coming. I'm personally a little skeptical. Having Siri AI'd up does absolutely nothing for me, and I don't know what that's going to do for everybody else. But we'll see.
And that is your trader's take. That's why
exactly.
we love Vince. Hey, Vince. We appreciate it. Vince Signorella, Bloomberg macro strategist. So let's get right to it. Jackie Davalos is Bloomberg tech reporter, and she joins us live from Apple's Worldwide Developers Conference in Cupertino, California. So you get a trader being like, I don't know why Apple's up. I don't know why AI Siri is going to work for me. Are we going to get something that's going to make Vince excited?
Can you blame him, Alex? It has been a long time coming, waiting for Apple's big AI vision reveal. Now, today, the central theme will be artificial intelligence. We know from Mark Gurman's reporting that its new AI system will be called Apple Intelligence, and that will be infused across its iPhone, iPad, and Mac operating systems. We also know that there will be a big announcement with OpenAI announced, which will infuse the iPhone and other Apple products with a chatbot, which Apple does not have one of its own. This is important because the company has sort of been a laggard in comparison to Microsoft and Google. And so today it will show just exactly how it plans to use not just regular old AI, but generative artificial intelligence across its devices.
Hey, Jackie, I guess I missed my invite, but who actually goes to these conferences? Because this is a big deal out there in Silicon Valley.
That's right. WWDC, as it's known, is held every year. It's a developer conference. So this is where the developer community really gets a preview of the software and hardware updates in the pipeline so they can start building their apps. Today, the main theme, of course, will be AI. And it's also important because if you remember last year was all about the Vision Pro and what apps would be integrated onto it. We'll get some of that today as well. But today, we'll really be looking to see for signs of how Apple plans to kind of reinvigorate its devices with AI and what that means for its hardware going forward. The focus will be on just how you can leverage large language models in voice, for example, to be able to tell your apps how to do something conversationally versus looking at a screen of just a bunch of apps on your phone. Kind of that interaction and a preview of that is what we're looking for today.
Do you think we're going to get any of this? Or how, I mean, if you take into account, I realize that you're not an analyst, and we'll get to that in a second, but when you have the stock run up, is it a buy the rumor, sell the news kind of situation? Like, is anything going to live up to all the hype?
You know, when you think about Apple's advantage, really, it has billions of devices in people's hands. So even if its AI strategy doesn't really compete with a Microsoft or a Google, the fact that it has the reach across billions of devices is key. And so when you think about Apple kind of being able to monetize this going forward, that's going to come down the pipe, but it's really looking to get back in the game and show that it does have an AI strategy like its peers.
All right, Jackie, thank you so much for joining us. We really appreciate it. Jackie Davalos, tech reporter for Bloomberg News. She is live from Apple's Worldwide Developers Conference in Cupertino. We'll check in with Jackie in the next hour as well to get some updates. Let's bring in Anurag Rana. He's a tech analyst for Bloomberg Intelligence. He's been following Apple stock for decades here. How important is today, Anurag? I feel like Apple doesn't have the AI juice in its stock. Is that something they care about?
No, they have to care about it because that's the most important thing in investors' mind right now. So there are a few things we already kind of know, thanks to Mark Gurman, is there's going to be most likely an announcement with OpenAI, some kind of joint agreement with them to use their technology into the new operating system. So I would say a lot of that is already built in. We all know that Apple doesn't have its own large language model as good as what's available with OpenAI or arguably with Google. So, but they can partner with these two companies. So that's the luxury Apple has, that it does not need to do everything in-house. And that's what we're going to look forward today is what's the strategy in terms of working with partners and then using that technology to fuel the operating system.
Will it justify the run-up in the stock? How do you make the correlation between the news and what we're actually going to get and the actual move in Apple share price?
So, Alex, one of the things I would say is for the past 1.5 to 2 years, there has been nothing but bad news coming for Apple. You know, that has been an issue because iPhone growth has slowed down, mostly because of China. So I would say this is the first sliver of good news that has the potential to improve iPhone sales next year. It's not going to do anything this year. I mean, it's very difficult to model that out. But if the operating system has enough juice for people to figure out and say, I will go out and change my phone next year, I think that is the gas people are looking for, is whether that can go back and reignite sales growth.
Anurag, we were talking with Mark Gurman earlier this morning, and he kind of suggested that, you know, it could be taken as a little bit of an embarrassment by Apple that they do not have, kind of their own AI capabilities in-house, that they need to partner with OpenAI. Do you think investors view it that way, or they're just like, hey, we don't really care how you get it, just put it on the device?
Yeah, but personally, I don't care how you get it on the device. Same thing for search. What I really like about that, if their partner is, then they don't have to spend billions of dollars to do it in-house. If you look at the capex of Apple compared to some of the other companies, it's much smaller. And, I'm okay with that because it helps out in my free cash flow. As long as they can partner with people, I'm absolutely fine with it.
Well, let's go to the idea. Let me bring my daughter into this. So I'm doing a lot of reading yesterday on Apple. I'm taking all my notes. I'm doing my homework. And I said, hey, Dylan, I was like, that Apple's going to have this thing tomorrow, and they're going to maybe unveil something that will help emojis, and you can get better emojis when you're typing text. And she's like, that is so cool. When are you going to get the new phone? And I think, Anurag, that's your point. Where people like my daughter are like, that's awesome, upgrade your phone now. Because I'm like, oh, a few years. She's like, no, you got to get the phone because I need the emojis so I can send texts to my friends. That's basically what you're talking about. There's a huge install base. You do something that even is like semi-cool, and that's going to drive sales.
Yeah, I mean, that's the coolness factor. And frankly speaking, one of the things that really caught my attention is Mark Gurman reported that the new features would be available on iPhone 15 Pro and the newer one that's coming. I mean, that's a big deal because, frankly speaking, if that's a very small portion of the total install base, even those early adopters, if they go out and rush to increase their, the refresh the phone in a much quicker way, that's going to help out Apple.
All right, so what else today should we be looking for, Anurag? I mean, is there going to be a new watch, a new anything, or is it just getting everybody to focus on AI?
Yeah, it's all going to be AI. And I think one of the things I really liked, what I have seen from Apple in the last 6 months, is now they are all focused on this product. Because one of the things, again, Mark said that, they shut down the Cards project, which has been around for, so many years, taking out massive amount of investments, and then you could say that they diverted that attention and not focused on AI completely. But right now, the entire company is focused on AI, embedding it every product, every operating system, every feature. And I think, one of the things we have heard even in China is consumers don't like that Apple's been behind in this particular one, and that has been a reason for them not to upgrade their phone. So I think Apple's taking this a lot more seriously. I think other tech companies are taking it a lot more seriously, who have been, I would say, taking their dominant position in their respective markets for granted over the last few years. And that's what I think OpenAI has done for the rest of the ecosystem also.
Anurag, what are the derivative plays from this when we're hearing the announcements from Apple? In your world of software, where should we be paying attention to?
I think, what we think is going to happen is, over the next 1 to 2 years, every software company is going to embed more AI features into their core software product. Now, the question is, some of them will have the ability to upcharge for that, which means they will have a Pro model or a Premium model or a Pro Plus model where the average revenue per user can go up. This way, they don't have to go out and look for a brand new user to sell that software. They just have to convince the buyer that it is worth your while to upgrade that software into the one that has AI features. I think that is where bulk of the investments are going to in terms of the software industry. We think every major company will play a role in it. The ones that we have seen so far is stuff that's coming out from Microsoft, whether it's in the Office suite or the one that we like quite a bit is their coding software, where the software developers can actually do automated coding in a much faster way. I think that will have a massive upsell rate because the benefits of productivity are way too high over there.
All right, Anurag, 30 seconds. Question of the day. I have an iPhone 11. Do I upgrade now or wait?
This winter, when the next one comes in, which is the iPhone 16 or so, I think you will be very happy with that particular one.
iPhone, did it work? Like, can you run stuff?
Yeah.
But at some point, like, the apps just don't update and the software doesn't update, and like you have to turn it in.
Well, the big thing that what always prompts me to upgrade is the battery. When a battery starts, that's the message. All right, Anurag, thanks so much for joining us. Anurag Rana, he saved me a couple of dollars today. I'm not going to go out and buy a new iPhone. He's a senior technology analyst for Bloomberg Intelligence. Yeah, it's always the battery that kind of gets me.
The battery's rough, yeah. But I do my thing on like low battery all day. Like, you don't do that.
No.
I do, yeah. Which is fine. It just means that instead of like staying up and connected for a long time, it just goes to sleep and then I just have to wake it up.
Really?
Yeah, but it lasts
I
like
don't know
a really
anybody
long
that does
time.
that. You're the first person that.
Doesn't this track for me, though? I don't know. I feel like this all makes some deep sense. Anyway, we're definitely watching Apple and looking forward to that announcement coming there. It has a really big run-up. All right, coming up, we're going to have a lot more for you. Carol Pepper, founder and CEO at Pepper International, joins us for her outlook for the market.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks right now, they're lower after a hotter than expected jobs report pulled the stocks lower Friday. That data pushing investors to feel that the Fed will keep rates higher for longer. We shall see this week. Policymakers announced their decision on Wednesday. That morning, we'll also get a key inflation print, the Consumer Price Index. So right now, we have the NASDAQ down about 0.1%, 25 points at 17,109. The Dow, little change, down 17 points at 38,781. in the S&P 500, down about 0.1%, 6 points at 5,340. Over to the bond market, the 2-year yield's 4.87%, down 1 basis point. The yield on the 10-year, 4.46%, and that's up 2 basis points. Checking in with commodities, we have spot gold higher at $2,304 an ounce. We have Brent crude $80 a barrel, WTI crude $76 a barrel. NVIDIA begins trading today. You guys talked about it after its 10-for-1 stock split takes effect right now. NVIDIA is down about 0.7% at $120. And we have news about Meta. Meta shares up about 0.5%, but the U.S. Supreme Court, it's agreed to consider killing that multi-billion-dollar investor data harvesting suit after that federal appeals court let that lawsuit go forward. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa. I'm Alex Steele, alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We're broadcasting to you live from the Interactive Broker Studio right here in headquarters in a beautiful Midtown Manhattan. Lisa was just giving you a check on the market. Also, Apple is down a touch, but it has a huge run-up since the end of April. NVIDIA is also down on that stock split. So we want to dig a little deeper here with Carol Pepper, founder and CEO of Pepper International. She joins us. Hey, Carol, do you want to buy Apple into today? Like, do you want to buy NVIDIA on the stock split?
Definitely buy NVIDIA on the stock split. I think that that's just a great sign, and NVIDIA is going to run right back up to over $1,000 a share. It is the engine right now, so I would definitely buy it and tuck it away and not look at it. Just leave it there. On fear days, it'll go down, so on a fear day, buy the stock.
So can we broaden that out, Carol, to say continue to buy some of these large cap growth stories across the board, or do we try to find some value out there?
No, I definitely feel like the value is large cap growth. Frankly, the leaders and the bigger stocks are getting bigger. They're in a position with all the cash on their balance sheet to be very muscular, to make the innovative deals, to make long-term investments where other companies are struggling. So in tech, at least, bigger is much better, and that's where you need to stay. And again, if you haven't fully filled out your tech allocation, it's something to take a hard look at. In general, I think growth will continue to outperform value. It has for over 10 years, and I don't see that trend ending anytime soon, although it's still very prudent to own the entire S&P. The U.S. stock market is going to continue to outperform the rest of the world, certainly for the foreseeable future.
You know what you didn't mention, though, Carol? You didn't mention Apple. You're talking about large cap growth. We're talking about tech. I asked about Apple. You didn't talk about it. Makes me think that that's not in this thesis you have.
Well, I mean, the problem that I've always had with Apple is I feel like their product set is not that broad. I mean, okay, how many iPhones do people really need? Yes, you might upgrade the phone that you have, but are you really going to penetrate larger groups of new users? I'm not so sure about that. They're very expensive. We're in a high inflation market. I'm not as excited about Apple as I am about the other big tech companies like Amazon, certainly Microsoft, NVIDIA. We've got Google, even Facebook. You've got companies that are branching out into more areas of growth and expansion. And to me, Apple's fairly focused. The car thing was a mistake, and now they have to backtrack on that. I mean, they're still always going to be in the top 5. Don't get me wrong. That you can own them. I'm just not in love with them as, let's say, the leading story.
So, are you in love with Microsoft and Amazon?
Yes, I've always been in love with Amazon since the very beginning, since they went public. Microsoft, I think, is very, very strong and will continue to be so. They have a much stronger focus on, I think, the corporate side of the business, and that's very smart because all of this AI innovation will start affecting corporate America, and Microsoft will most likely be one of the main delivery mechanisms because they're embedded in so many corporate systems and so many, Outlook systems and all the cloud storage that they're doing. I don't think that that's going to change.
So there was a great piece on Bloomberg that talked about how big tech's profit growth is going to slow. It's not going to go negative or anything. It's just going to slow from the kind of growth that we've seen. But that other areas like industrials, materials, and healthcare can see roughly 25% profit growth by the fourth quarter after a contraction of 20% or more in the first quarter. So I'm wondering, are you in love with stuff outside of tech and maybe in those sectors?
Well, I certainly think those sectors have room to move, which is fantastic. Certainly the GLP-1 story is going to continue and expand. We're going to see new drugs coming on, and that is a blockbuster category. But I also see that AI is doing tremendous work in things like cancer research and coming up with real cures in the health tech space. So I think healthcare will also always be a good core holding. But if you were to say what weight to put it on, I would overweight tech more than I would overweight healthcare, though, of course, to me, healthcare is a continued growth story because we have a lot of aging populations all over the world and they just simply need more healthcare. So yes, I mean, healthcare is always a good sector. Anything growthy is your friend. It doesn't mean the other sectors won't catch up eventually because a rising tide will lift all boats, especially when the rates start to go down. That's where I think you'll see value start to move some more. Because with value, you know, you just have very much smaller margins to play with. So when you have high interest rates, you're more squeezed. And it's very hard to get out of that squeeze any particular way if you're not in a sector that's growing.
Hey, Carol, one of the themes coming out of the pandemic was onshoring and friendshoring. And a lot of folks are saying, take a look at Mexico. Is that a theme you like? And if so, how do you play that?
Yeah, absolutely. Well, as you guys know, I manage money for ultra wealthy families with over $100 million family offices, and they're very much looking at Mexico. There's a huge real estate play going on now between Mexico and the United States because many businesses are relocating their operations out of Asia to Mexico so that they can just drive goods right across the border into the U.S. if they have to. So they're preparing for the next pandemic, frankly. Mexican, you know, they had a huge election. The election went left. Of course, the wealthy families over there are quite nervous. But the incoming president has really pledged to not mess with the economy. And so far, so good. I don't think she will. Question becomes, how much will the outgoing president pass his agenda before he leaves? But having said that, I think they're all very happy with the way the economy has been growing over there. So yes, Mexico will continue to grow. It's only actually just getting started. And there's a lot of activity in the real estate section. There's a lot of joint venturing between U.S. and Mexican family offices going on. So keep your eye on Mexico. It's also a fantastic retirement destination for Americans who can't afford to stay here with the current retirement. I mean, you can live on your Social Security beautifully in Mexico, and you can't do that in the U.S. in retirement. So there are already massive communities of retired Americans living across the border. And again, it's easy for them to get home if they prefer to have healthcare in the U.S. But it's a big trend. It's going to continue to grow.
Well, my best friend's pushing Costa Rica. Like, that's her thing. Like, they're going to move her family for a year. Anyway, so, yes, that is a trend, Carol, for sure. Just a headline that's crossing here. I feel like this is for Paul, because he'll get into it. BTP Bund spread, 10-year gap, rises to 55 basis points, the highest in a year. And that's the difference between what the 10-year yield in France versus Germany is yielding. And since Germany tends to be looked at as the risk-free rate over in Europe, it's a sign of where the stress is. Before the sovereign debt crisis, France was really thought of as stable along with Germany, and the debt crisis kind of got rid of that a little bit, and there was more political risk over in France. Also, the equity market just getting crushed. Did we learn anything, Carol? Like, I know you're a U.S. person, but did we learn anything about what happened in the European Parliament and Macron's choice to call these elections for the lower house in relation to how we can trade and expect things here in the U.S. in November?
Oh, that's a really interesting question. Well, I would say in my opinion, the vote in the EU was a one-issue vote. It was an immigration